All right. Good morning, everybody. Good morning. Good morning. I know some of you took that long on crude, right? That's okay. Totally cool. No worries at all. I thought it would be fun to go through my read on it, though. And we'll talk about it after we talk about rules. Um, but the point that I was making with my pictures, guys, is that it's easy to want the market to do something. It's easy to wish the market would do something. It's easy to say, man, it should. No sound. Can anybody hear me? All right. So finally, we learned how to shut Ron out. There we go. So we'll give it a second then. Good morning, Miss Cindy. Good morning, Joel. Good morning, Andy. Good morning, Ron. Good morning. Who else is in here today? Paul's here, and I think Cav might be bouncing around. Haji and Jerry and all the cool kids. Rob, you're here. Yeah, you are. No sound, Paul W. Can't hear. Hold on. I'll reboot. Sorry, YouTubers. I am coughing in your ear. Didn't mean to do that. My bad. Discord has given us some technical difficulties. We're going to work through it here. All right, coming back in. I'm going to speak on the stage. Can you guys hear me now? You guys good? Awesome. Gotcha. Dun, 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 dun. It is a beautiful Wednesday morning, 9:02 a.m., guys. Let's check news. And let's talk about what today's news means for everybody in the world. Today's Wednesday, May 1st, and every morning I go to forexfactory.com. And guys, I even got a message from someone this morning. And their exact words were, after the shit show last month, I'm not even trading today. I thought that it was kind of funny. Really, son of a... All right, there's a mic reboot. Can you hear me now? Joel has me. Okay, you guys are good. So if you can't hear me, Control Alt Delete and use your task manager to kill Discord. So let's see if that fixes it for you guys. Man, Discord's doing weird things. I'll do it again just to make sure. And see if we can get volume for everybody. Hold on. I'm going to come through and I'm going to kill it here. All right, guys, I did a full kill too. So hopefully that works. Can you give me a Y in the room? Yeah, Andy says yes. I like it. I promise I'm not trying to shut anybody out. Cindy, you got me? Ron? Paul? Talk to me, guys. Talk to me, Goose. Grant says yes. I like it. Well, if you can't hear me, it's because I don't like you. So, ha 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 ha. Not really. Man, all my connections are good, and if half of you can hear me and half of you can't, I'm inclined to believe that it's on the user end, not my end anymore. All right, I'm going to do it one more time. And again, YouTubers, I apologize. All right, guys, that is as fresh as I can start over. So if you came back into the room, let me know that you can hear me. How we doing? That was 100% disconnect, reconnect, reboot, everything I know how to do. So fingers crossed. Or if you're from the Pacific Northwest, fingers across. Plugged it back in, yep. But I'm blaming Discord. Guys, we're checking news today. While everybody comes in, we're going to check news. Wednesday, May 1st. At 8:15, it was an absolute dud. There wasn't a whole lot that happened from the 8:15 news. But a lot of you will notice that at 8:30, the market went absolutely bonkers for a second. At least NASDAQ did. There was no news release or anything like that. There were bots or algorithms or something waiting at a level, and it pushed it. News at least gives me an idea of when stuff like that may happen, although it doesn't guarantee that it won't happen without. So at 9:45, I've got high impact news. At 10 a.m., I've got high impact news. So at 9:45, 10 a.m., guys, that's a great time to go grab an Egg McMuffin or something, because the market has the potential to go absolutely nuts. All day, there's the words total vehicle sales. It's weird that that's an all-day thing, but it is low impact. I'm not really worried about it. And then at 2 p.m., guys, FOMC. If you have never been in front of the markets at FOMC at 2 o'clock, I would say watch it. You're going to be tempted to trade it. You're going to be tempted to try and take these miracle longs and shorts while the market looks like a seismograph. Guys, FOMC typically creates about 20 minutes of a market volatility that is so fast that your software and nothing can keep up with it. So you see 20 bars in one direction when there's actually 20,000, or 2,000. And the market moves so fast that you will, I've seen people do it. They try to enter a trade and they're literally stopped out $2,000 below or above that trade, because the market is so volatile by the time there's fills and stuff like that. So I never tell people when to trade and when not to trade. But if my wife called me and said, "Hey, Mark, I'm going to trade FOMC today," I would say, "Honey, we've got to call that divorce lawyer. That's a horrible idea. You're making bad decisions." As though marrying me wasn't bad decision enough, now you're compounding. So, guys, knowing that this is happening, some other things that happen with FOMC days is the market doesn't always follow through. The same is true 10:30. We have crude oil inventories. Pre-inventories, crude oil doesn't always follow through. These are the days where, I mean, I try to insist on my rules all the time, but just like anybody capable of reading charts, I'll bend a rule every now and then because of the conditions on the chart. This is one of those days where I typically choose not to bend any rules. This is one of those days where I spend more time doing nothing than something. And honestly, right before class started, I was looking online for a tea time. I'd rather go golf than trade FOMC. That's just me. But I do this every day. I go check news every day, and it gives me the advantage of knowing when things may go crazy. And today, things may go crazy for most of the day. Everything that I talk about from the education page. So I know that I have some newer faces, got some older faces. There's only 18 of you in here. That's weird. Maybe it's May. Everybody's like, "Hey, it's Uno de Mayo," which isn't nearly as cool as Cinco de Mayo. The education page, the tutorial section, guys, this is where all the answers come from. This is where I'm going to make sure that you guys have everything that you need to be successful. That's my goal. My goal isn't to make you amazing traders. My goal isn't to make you a successful trader. My goal is to give you everything that you need so that you can become a confident trader, so that you can become a confident chart reader, so you can use this software, this amazing software, to your advantage. That's the goal. I can't make anybody wonderful. That's up to you. I'm going to give you everything you need to get the work done. So all of your answers come from here, and I want to go to the glossary of common terms first. And I do this every day, guys, and I know that I sound like a broken record, and I love each and every one of you that keeps coming back to hear the same damn song. High probability trend trade. Each indicator on every chart is going to agree for the rules of the trade, guys. All your triggers are going to be the strongest. There's nothing in the way, nothing between you and your targets. The reason that I talk about the high probability trend trade so extensively isn't because it's the only trade that you'll ever take. I talk about it so extensively because this is the trade that teaches you to read your charts. This is the trade that puts you in the position to look at your software um, and understand what it's telling you. Jerry, I believe June 1st is the hope. Fingers crossed. There's a lot of work to do. Starting May 15th, I go 100% full-time, split between education for Nexgen and then working for the funding company as well. John, the pro room ended yesterday, so he is investing all of his time into the funding account now. It's just full speed ahead. There is an awful lot that has to be done, but we're working diligently. I'm excited. I'm so excited because I think this is going to be, and I don't know, and I'm not touting anything that is or isn't true, but our goal in the funding company is that everybody gets paid. Our goal in the funding company, when I talk to John just casually, not business, he's like, I don't want people blowing out. I want people making money. I want people getting paid because when they're getting paid, that's how we get paid. So, guys, my job is to give you guys the best foundation ever to get paid. I don't know yet, Jerry. I don't know yet. My guess is you should be able to, but I'm not sure. Um, AMP futures will be clearing. And John's got a relationship with AMP futures that extends decades. And I promise you he will work that out because he likes to use copiers. So I would be surprised if that wasn't a part of it. Um, Not a damn thing, really, Paul. Same thing I do here. Not a damn thing. Um, I'm going to be that voice of reason in your ear. My goal is going to be education, creating education. My goal will probably go into account analysis and stuff like that. So as people go through and do things and they begin to go into those live, I'll take what I know about understanding trading plans and look at it and look for consistency. And then really just a sounding board for my brother, taking his really, really smart stuff and making it accessible to the rest of the world. Thank you for that, Jerry. Um, I hate to admit it. Gosh, I hate to admit it, but I will. Guys, one of the reasons that I'm so good at what I do is because I'm just not that smart. And I'm not saying that you guys aren't, but I struggle with change and I struggle with new things. I'm very much a systems and routines guy. So I take education as though nobody knows anything, no matter what you know. And we can build this great foundation to grow from. And I've made every mistake that you guys will ever make. Most of them I've made 1,000 times. So how glass house stone throwing would it be for me to get on to anybody for making mistakes? Guys, I want you to make mistakes. That's how we learn. And one of the easiest ways to avoid mistakes is become a chart reader, guys. Chart reading is like 90% of what we do every day. I had an awesome conversation with someone the other day. I was like, guys, chart reading sets you up for all the stuff that you want to do. Chart reading sets you up to be able to understand advantages. And chart reading, it creates patience for you. And it's kind of this two-sided, double-edged sword because chart reading will also help you form opinions. Chart reading will make you trade without advantages if you embrace the read rather than the rules. So we go twofold, guys. We talk about the chart readings, and you will understand where the market is likely to continue, where it's likely to go, where it's likely to stop. And then you'll take your ability to recognize advantages, to understand these concepts and apply them to rules. And when we talk about rules today, guys, rules are are solid. They're concrete. Rules are patterns that repeat themselves every day. Rules should be testable. Rules should be proven to win more than they lose. And if you are taking trades that don't provide you a statistical advantage, then you're doing yourself this huge disservice. Your chart reading will let you know when the advantages are present, guys. And we're going to talk about the most basic forms of advantages. We're going to talk about three very simple concepts through that high probability trend trade. And once you understand the three, like the back of your hand, once you can look at a chart and say, I have this advantage, I don't have this advantage, what happens is everything kind of falls into place for you because you know when you are exploiting a condition in the market and you know when you should remain calm. So we're going to focus a lot on chart reading, that 90% of the day. We're going to let chart reading take us to entry precision. And then from entry precision, we're going to have to manage it. And it's that simple. But everything begins with chart reading. So as we go into our quest to become chart readers, the fastest way for you to get good at it, the fastest way for you to be proficient, the easiest way for you to understand what it is you're looking at is to post a picture in the room and tell me what you see. And it's really that simple. It's like the Rorschach test, right? Tell me what you see. And I'll tell you if you're crazy or sane, right? I'll give you feedback on everything that you see. But what this does, guys, is this opens up the door for conversation. This opens up the door for lessons. And my lessons in this room after the first hour are 100% dependent on the pictures that you guys put in the room. So just hypothetically, if Debbie sends me a picture and she goes, you know what, Mark, I took the short right here because everything was red and I got stopped out and I'm so mad about it. Then what that does is that opens up the door for conversation. And you guys all know it. Each and every one of you is looking at this picture saying, but Mark, that's a termination condition. Absolutely. But somebody needed that lesson. Somebody needed that lesson so that they could embrace the advantage or the disadvantage of trading into areas. And when you guys post the picture and you talk about what you see, and you guys post the picture and tell me why you did what you did, it's just a private session. You and I are going to have conversations. If there is a flaw in your chart reading, we will correct it. We'll turn it into a lesson, and I will give you opportunities and study materials and all the things that you need so that you can avoid making those mistakes. And that's really how posting in the room works. And the second is using the spreadsheet. First tab is your trade journal. Every time you take a trade, put it in here, especially if you lose, because you're going to talk about the advantages. You're going to talk about the feedback from class, but most importantly, you're going to go back and study it each and every morning. Some of you will omit this step because you'd rather just get to trading. Those of you that find success sooner than others will go back and study what you did yesterday, and you'll say to yourself, man, this is working. Let me keep doing this. Or this isn't working. Let me stop doing this. You'll find a correlation between following rules and feeling relaxed. And you will also find a correlation between breaking rules and feeling nervous and jumpy and moving stops and targets too quick. So if you pour a cup of coffee, you go check your news, and then you just start looking at what you did yesterday. You're going to set yourself up for success. You will accelerate the learning process through that little bit of study, because the reality is that recognition comes through repetition, guys. The more you see something, the easier it is to recognize, which is why there is the client trade section, which is about 300 pictures of you guys being brilliant, embracing advantages, taking trades, management opportunities, all sorts of stuff in the green section. There's the entry sequence for the high probability trend trade. There's a very basic management plan, patterns, termination conditions. All of this stuff is here, made available to you. I drop it in the room each and every day for you. And if you just went back and studied each of these pictures, you would begin to see things that line up. You would begin to see consistencies. You would begin to commit looks to memory that are turning you into a chart reader. And when the looks that you see fit your rules, when they are something that provides a statistical advantage, when you can prove through 20, 50, 70 pictures that it is a pattern that wins more than it loses, well, that's when it goes into your favorite looks. Guys, this is you building your trading plan. I will give you a plan today. But you're going to create your own, and it's going to be based on your ability to read the indicators. But as we focus on the high probability trend trade, this is a trade that has 3 rules. So let me do this real quick. This is a trade that only has 3 rules. It has strong triggers, no termination conditions, and then your entry rules. Each rule provides an advantage. I've set up a tab on the workspace or on the spreadsheet for you where there are 3 green sections. And this is where you're going to put pictures of the individual rules being met. You're committing them to memory. And then there's 2 red sections, which is where the rules are not met. And you'll also commit those to memory because what you want to do is know the difference between strong and weak triggers. You're going to want to understand the difference between a clear path and a termination condition. And then it goes back to those entries. So I give you guys every day this 101 drill is what we call it, where you're going to go back and you're going to take 25 pictures of each. And there's no doubt in my mind that if you do that, that if you focus on just understanding these 3 advantages in the market, the world becomes your oyster. It opens the door for thousands of opportunities. Every day there's something to do, and it all is based on your ability to understand momentum, a clear path, and an entry area. It all comes back to that each and every day. So post in the room, tell me what you see. Fill out that spreadsheet, but go back and study it. Don't just take pictures for the fun of it. We're going to learn the trigger line and Fibonacci rules for when it's okay to trade. We're going to talk about those 3 rules for the high probability trend trade. I do not want to see you guys just stuck on this trade and thinking that you're shackled to it. I want you to use it to learn how to read your charts so that you can open the door for more opportunities. Simulate, practice. Guys, simulator is freaking amazing. Simulator means that you don't have any risk. It's like Monopoly money. Simulator is where you begin to learn your plan, where you begin to learn your rules, where you begin to practice your rules, both entries and management. Simulator is one of the most invaluable tools because it moves exactly like the live market. I mean, it moves exactly like the live market. Even the fills, everything is the same. So what you're doing is you're creating muscle memory. But the idea is that you want to create the right memory. You want to practice like you want to play. You want to pretend like it's real money. So we don't want you practicing the wrong rules because what happens, and this happens all the time, and I think everybody in this room, including myself, has said it. Yeah, Mark, I know I broke the rules, but I got paid. I know I broke the rules, but I made $500. I know that I didn't have any advantages, but look, this one worked. I got a little bit out of it. And the reality is, guys, is while that feels good in the moment, that short-term victory, it typically translates to a long-term failure because luck runs out. The people that move the markets know exactly where your stops are. They know exactly where your bad entries are. They understand the emotions that you're going through, and they feed on it. So we want to keep our trading very pragmatic, very, very focused on advantages. We're going to simplify a lot. Holy smokes. We're going to simplify. I'm going to give you two trades. 2 trades to optimize your chances of success. 2 trades based on 3 advantages. 2 trades, just keeping it simple. But you've got to learn the looks so they're easy. And that's where taking pictures comes in, guys. That is where looking at the same thing over and over. There you go. That's it, Ron. What a morbid little thought, but that's probably true. The more you see the same thing when the market isn't moving. Remember, if I click on this picture, what's pretty cool is that I don't feel any pressure to take this trade. I don't have any nervousness. There's no anxiety. There's no threat of win or loss. All there is analysis. And that analysis starts to burn into my brain. So what I see when the market isn't moving makes it easier for me to recognize the exact same looks when the market is moving. And that's kind of what we do here. It is very much recognition through repetition. So use your spreadsheet, but let's focus on 3 rules. Your brain's going to say, Mark, if 3 rules is good, well then 5 rules has got to be outstanding. It's not necessarily how it works, guys. These 3 rules for the high probability trend trade, each one gives you an advantage. The first rule says strong triggers on a large chart. When it's true, you have the advantage of momentum. You have the advantage of a market that's likely to continue with the trend. It's an outstanding advantage. It feels good, but it's not a standalone. Next, you have to make sure that there's no termination conditions. None of those areas likely to stop the market. And if that rule is true, well, then you have room to your profit targets. We're going to call that a clear path. That's your second advantage. So you will learn to speak to yourself and say, as I look at this chart, I have the advantage of momentum. I also have a clear path. Well, let me go to rule number 3 and find an entry. And guys, these 3 rules happen on only 2 charts. Your first chart on the most current bar, it's just a slow moving big broad stroke of a brush. You will be able to define the direction, the momentum, and the areas of the market, the overall thought in the market. You will understand exactly what the people in charge want to have happen. And it's the easiest way to think about it. It's the large crowd on the large chart. And these are the guys that aren't you. These are the guys that make things happen. These are the apex predators, guys. They have all the money. We don't have to fight them. We don't have to battle them. We don't even have to form opinions about what we hope they're going to do. We simply let them do it. And then we get our piece from what they create. So 2 charts. Let the large chart lead the way. If the background's green, it's going up, go up with it. It's the easiest thing to do. And if the background's red, it's going down, go down with it. It's like a lazy river, guys. If you've ever dropped your sunglasses on the side of a lazy river, it's easier to go with the flow and pick them up on the next lap than it is to walk against the current. The large chart's very much like that. And then we have a small chart. Small chart's just a refinement tool. I'm going to take that 1 bar and create like this X-ray. I'm going to see 20 to 30 bars on a smaller chart that happen inside of the large chart. And that's the small crowd. These are the guys with brass knuckles and bad attitudes. They love to fight the large crowd. They love to push down when everything says up. We're going to rely on these yahoos to push us right down to the perfect entry. And that is where rule number 3 comes in, guys. That is exactly where you guys are going to pinpoint entry using that refinement process. It will allow you to reduce your risk dramatically. It's going to increase your profit potential exponentially. And it's just a very simple 3 rules, 2 charts. Rules 1 and 2 are met on the large chart. Rule 3, your defining entry, happens on a small chart. So rule number 1 says that we must have strong triggers. This is large chart, guys. This is your 13.2 on the crude, on the S&P. Strong triggers is the same look no matter what time frame you're on. Strong triggers is always strong triggers, whether it's a range chart or a day chart or a month chart. Whether I'm looking at stocks or cryptocurrencies or futures. Strong triggers is consistent 100%. And in order to have strong triggers in an uptrend, when the background is green, my small triggers, which are a fast-moving average, and my large triggers, which are a slow-moving average, they work together to let me know. The smalls break above and away from the large triggers, and it's the space created between the two that lets me know that the odds are favorable for the market to continue up. Guys, you're going to hear odds favorable momentum in this room all day long. Did you have odds favorable momentum? You're going to see charts annotated with OFM. In a downtrend, when the background is red, the smalls are below the large are wide, they're angled in the direction of the trend. The odds are favorable for the market to continue down, and it really is that simple, guys. That separation means strength, and when I have strength in a move, I'm going to buy Fibonacci support on a smaller, faster chart. I'm going to sell Fibonacci resistance on a smaller, faster chart. On your large chart, the slow chart, it looks like a tail or a wick. On your small chart, that's like 30 bars in there that gets you right back to the perfect spot. So we're going to use these tails to study, but we will refine on a smaller chart to recognize them. So let's go to the live market real quick, and let's see just for grins if there's any such thing as odds favorable momentum. Well, there's odds favorable momentum, and there's one of those tails, and there's odds favorable, and there's odds favorable. And this really isn't a very difficult look to recognize, is it? Separation between the small and large. Guys, that's a market that's likely to push, and sure enough, it does darn near every time it happens. So is everybody good? Rule number 1, guys. Look at that. The larger down and the smaller up. That's not momentum, is it? They don't even match. That can't be momentum. Rule number one sets the tone. Rule number one can push the market. Rule number one can break key areas. Rule number one can cover mistakes. Guys, rule number one, I just don't let go of it. And rule number one won't last forever. You're going to have odds favorable momentum. It's going to happen all day long. And that's the best of the best to sell resistance on a smaller, faster chart in this downtrend. And what happens is you start to grow with the software, you begin to recognize things, you begin to read your indicators, you begin to identify advantages. And when one line of the triggers works into the large, right, they begin to come together, momentum is slowing, and you're going to know that. And that's what you're going to say to yourself. You're going to say, hey, self, momentum is slowing. I'm losing the advantage of that odds favorable momentum. The market isn't necessarily likely to push in the direction of the trend so much. So let me use my chart reading. And if everything agrees, I'll still take a shot and try to get paid. And then the smalls work inside of the large triggers. And we call this a weakening of the large triggers. And when you weaken large triggers, anything can happen up or down. I'm a big fan of language. Most of you guys know that. If I had $100 in my pocket, and that's it, and someone said to me, all right, Mark, what are you going to do with that $100? Are you going, where's my highlighter, to take a trade where the odds are favorable for the market to continue down? Or do you think it's better to risk your money on anything can happen up or down? And when you kind of put it in that place, when you begin to speak to yourself in terms of advantages, it almost becomes second nature to sit on your hands, to do nothing, to not forfeit that advantage. Weak triggers can create larger pushbacks. Weak triggers can create big retracements. And when weak triggers hit an area, these are the areas that typically hold. These are the areas that stop the market, that create untradeable bounces. And that's my little segue over to rule number two. Because when you reach an area, it may stop the market. You guys will know about these areas long before you ever get to them. Termination conditions must be false. There has to be room to your profit targets. There needs to be a clear path. And this is another phenomenon that happens on the large chart. So quick check, make sure everybody's with me. The background is green, this market is going up. Everybody's good with that. The small triggers are above the large triggers. There's space between the two. The most current bar is telling me this. Does everybody see how I have odds favorable momentum? That this is a market that's likely to continue in the direction of the trend? Guys, this is a very important piece of the puzzle. Well, now I have to make sure that it doesn't hit an area, that we don't reach an area that may stop the market, that may create a bounce. And guys, the areas are where decisions are made. And I love that phrase. And I had this epiphany like 6 months ago, I think. These key areas are where the people in control may enter the market. These areas are where the people in control may take profits. And what you find when you reach these areas is that there may be a little bit of indecision. There may be untradeable bounces. There may be fights that happen. And because we know about them so long in advance, there's no reason for a Nexgen user to get caught in that fight. There's no reason for you guys to give money away trading into these key areas because you know about them. And with a little bit of study, you're going to learn to trust them. But the areas we're looking for are divergence highs and divergence lows. Magenta lines from a high, cyan lines, it just means light blue, from a low. Yellow 1-to-1s, we're looking for red Fibonacci resistance and blue Fibonacci support. These key areas are where decisions are being made by the people that move the market. And once again, I gotta tell you, it's not you. You're not the person that's going to make it go up or down. You're not the person that's going to establish its momentum or decide the direction of the trend. Let these guys do it. And when these guys bump into one of these areas, you're going to use your trigger lines to determine if they are likely to stop the market. You will be able to understand without question if they have the potential to break. And then you're going to have a very easy way of knowing if the areas are broken, if they're in the rearview mirror and no longer problematic. So we're going to use our trigger lines to determine when these areas are likely to hold and likely to break. And remember, these are where decisions are made. So the first thing that has to happen, guys, is price has to reach the area. Those price bars have to come down and reach support in this case. When they do, And I can't stress how easy it can be for you if you allow it. When they hit the area, all you have to do is ask yourself, where are the triggers? If they remain above support, guess what? Support is likely to stop the market. It really is that simple. I don't know if it's going to stop the market. I don't know if it's going to create an untradeable bounce. And hell, I don't even know if it's going to break. But what I do know is that if price reaches an area and the triggers remain above support or below resistance, well, then my advantage of a clear path is gone, and I make the choice to not trade into that area. So if we're going at a high, I'm going to give you guys some pictures today, and price reaches an area. If it reaches a divergence high and the triggers remain below, no more long trades into that divergence high. If it reaches resistance and the triggers remain below, no more long trades into that resistance. And if it reaches yellow 1-to-1's resistance, no more trades, guys. Wait and see what happens. It may create a bounce. There might be a full reversal. It may just have this little bing, bang, boom, bing thing. That's a technical term, where you could get messed up going both directions, or you could just be patient and lose nothing. These are termination conditions at a high. And of course, anything that happens at a high can happen at a low. If price reaches these yellow 1-to-1s and the triggers remain above, no short trades into it, guys. You don't have to be the first person in. You don't even have to be the last person out to get paid. Price reaches support, the triggers remain above. Don't go short, even with odds favorable momentum. There's one of those divergence lows, and when price reaches it and the triggers stay above, not one of you has to lose a cent hoping that the market goes down, guys. And this is a huge advantage. Understanding where these areas are, understanding that that very simple recipe is going to help you understand if they may stop the market. So if price reaches and the triggers don't break means no, well then when both the small and the large triggers get to the other side of an area, that area is considered broken. You'll notice that both the small and the large get through support. Support behaves as resistance. Once that path is clear, you'll notice that there's odds favorable momentum. Rule 1. Until it reaches the next area, we don't have to go through that calculation again. Areas in the distance are targets. You guys will be able to pinpoint exactly where that market is most likely to continue on a smaller, faster chart. The very top of this tail uses that refinement process. This is where you guys are getting into a short position with the advantage of momentum as well as a clear path. And because you see Fibonacci support off in the distance, well, you understand where the market is likely to go as well. It's all chart reading. It's 100% chart reading, guys. So you can say to yourself, if price reaches resistance, the triggers remain below, I choose to sit on my hands. I don't know what the reaction is going to be. How could I? I don't have a magic 8-ball. If both the small and the large get to the other side of resistance, well, resistance behaves as support. The path is now clear until we reach the next key area. For the brand new user, for the high probability trend trader, guys, these are your two options. It's either broken or it's not. It's either a clear path or it isn't. Once you get pretty solid with your chart reads, I'm talking like 2 weeks maybe, you're going to understand a third option. And this third option presents your second trade that's going to come on this plan that I'm going to give you. This is a trade that we call the 50-50 trade. And it's called the 50-50 trade not because that is your chance of success. It is called the 50-50 trade because 50% of your trigger lines will have broken the area, and they will have done it with odds favorable momentum. Remember, strong triggers can break things, but 50% of your triggers haven't made it through yet. 50-50, pretty clever, right? Guys, this look lets you know that the area has the potential to break because of the momentum the market is telling you that it has. It only has the potential to break. It's not a broken area. And what that means is that any trade you take trying to take advantage of it can't be a high probability trend trade because the high probability trend trade relies on momentum, a clear path, and an entry area. So this 50-50 trade robs you of your clear path. It liberates you of your clear path, which means that you're going to focus heavily on making sure that the momentum is the best, that your entries are very concise and low risk. And guys, that'll be your first medium probability trade, but it's very dependent on your ability to understand momentum and trigger location. Let's go through and let's look at these divergences. What is divergence? It's a loss of momentum. That's it. It's a loss of momentum. It is not a failure in the market. It is not a reversal. It's nothing more than the market goes down and up. That creates a pivot. If there's a loss of momentum, if momentum doesn't follow price, you're going to see that cyan line from a low or a magenta line from a high. All of that is calculated in the background, guys. It's done through different formulas, comparing MACD, BBs, and price, and retracements, and all that stuff. The only thing that you need to know about divergence, and I mean the only thing that you need to know about divergence, is that if that negative number prints, which is a byproduct of the calculation, and that cyan line prints to the right, let's just cover up this, and let's just say there was a loss of momentum at the pivot. That's it. Don't give it any more power than that. But we all remember the recipe, right? When price reaches the area and the trigger line stays above, now this loss of momentum has transformed into a termination condition. It's the recipe, the same recipe. The recipe doesn't change. Price reaches that divergence low, the triggers remain above. No more short trades. And what these divergences create is what we call a pivot stop out. This is your pivot. And then when price trades below and back above that divergence, now it's a pivot stop out. And when price trades below a divergence line and then back above, don't take any short trades. And the same is true at divergence highs, guys. The exact same is true at divergence highs. And it's right in the user guide. If price trades above a divergence line and back below, pivot stop out, no more long trades. These are powerful termination conditions, and they become more powerful still when they line up with Fibonacci support or resistance. So let's not give divergence this overwhelming power, but let's respect the termination conditions that they can create. And then my favorite picture ever, price reaches yellow 1-to-1s and the triggers remain above, and none of us go short, thank goodness. We all say, I don't have a clear path. I'm not taking that short trade. Hope doesn't work for me. I like rules. I like patterns that repeat themselves. And what happens is nobody gets stopped out. Nobody gives that money away. And the retracement takes you all the way up to Fibonacci resistance, even a little bit beyond, but the triggers remain below, and none of you went long. And once again, the powder stays dry, no losses. And this market goes through indecision for about 45 minutes. Notice that the trigger lines don't match. You don't have momentum. They're below resistance. You don't have a clear path. But everything that doesn't give you rules met here leads up to those rules being met. And guys, this is where when I say 90% of your day is spent reading indicators, 90% is waiting for advantages. This is your 90%. Where terminations go to terminations, where no momentum, terminations, and the market is in a fight. These are the sharks, guys. These are them fighting. This is your 90%. And you have two choices when your rules aren't met. When the rules aren't met, you can not trade, and that's free. It doesn't cost anything to not be in a trade. Or you can trade, hope, typically lose, maybe blow out, or go down $1,000 trying to predict what the market's going to do. And if you're patient, if you wait, eventually you do get odds favorable momentum. Eventually the path is clear. And guys, there's that 10%, right? There is that 10% payoff. There's that entry, that tail for the highest probability trend trade that you can take. I think it was Muser or maybe Haji, somebody said yesterday, when they stop trying to force trades, trades seem to come to them. When you stop trying to make something happen without advantages, the trades just kind of come to you. And the cool thing is that most of you have a goal of $200 or $250 a day per contract. Guys, that's about a $450 trade that is outstanding because of your patience. If you were down $1,000 trading your opinions, Well, you're only up, or you're still down $550, guys. You're still in this hole that you have to dig out of. And I find, just through my experience working with you guys, that it's not the winners that are creating successful traders. It's the ability to avoid the trades that don't offer you a statistical advantage. It's the ability to not trade into areas, the ability to not fight momentum, the ability to just let it be perfect because your money is worth it. So is everybody cool? Lines on the large chart define areas that may be problematic. Lines on the large chart let us know where decisions are being made. Lines on the large chart, man, if you just go back and look at a large chart, oh, that's a small chart, hold on. I want you to see, let's take one picture here. And this is what you guys should be doing. You can actually see the consolidation. Welcome to crude oil inventories. Price reaches no triggers. That's a textbook termination condition. Price breaks, pulls back to resistance, very much like the manual. Potential to break, but it doesn't. There's a pivot stop out. The market reverses. Potential to break, but it doesn't. Potential to break, but it doesn't. And guys, what you're seeing here is rule number 2. Defining where the market is caught in consolidation. And there may be opportunities between the two fibs. There may be opportunities on the potential to break, but you're going to have to use your chart reading to take advantage of those. You're going to have to use your chart reading to give yourself the highest chance of success. And there are easy ones and there are difficult ones. The easy ones typically pay the best. So what you're going to do is you're going to use those lines to determine where problems may happen, knowing full well that there still may be opportunities on a medium probability scenario, but the best of the best comes from that clear path. On the small chart, we're going to use lines to define entry points. We're going to use lines to tell us where to get into the market. So that's kind of the opposite of what we use the large chart for. Large chart defines areas that are problematic. Small chart uses areas very much, where's my cursor, like this, to get into the market. But there's one termination condition, one time on the small chart where I will say to myself, rule number 2 is not met. Rule number 2 is not in place. I do not have a clear path. And that is, on the small chart, 3 divergences in the same price range. The same is true on a large chart. 3 divergences in the same price range may terminate the trend, but a large chart's slow. It's going to take you a long time before that happens. But on a small chart, it might happen in a couple of minutes. And 3 divergences from a low or 3 divergences from a high say, hey, rule number 2 is not met. No more short trades. 3 divergences with weak triggers. Remember that look? Odds favorable. Anything can happen. Well, that adds a little fuel to the fire, guys. It's more likely to reverse the market. It's more likely to create an untradeable push. And then when you've got that higher pivot from a low or lower pivot from a high on the final, more powerful still. And you're going to use this look on a small chart to help you identify the change that you won't be able to see on that slow-moving large chart. So up here, with odds favorable and a clear path, you might get 3 divergences. And those 3 divergences let you know, don't take that last long. Things are changing. Same thing is true down below. So far, rule number 1 is met. We have the advantage of momentum. Rule number 2 is met. We have the advantage of a clear path, guys. Let's go let the small crowd do their thing. Let's go identify on a smaller, faster chart where the market is most likely to continue. You're going to do it with such precision that you're going to use a limit order. And you're going to wait for the market to come to you at these areas. And you're going to use that limit order at fibs, mid bands, yellow 1-to-1s. And here's the key. And guys, this is one of the biggest opportunities for you guys to stay consistent, is you're going to do it inside of what we call favorable large triggers. So on this small chart, we're going to see 2 sets of triggers. And let's talk about what both are, because I think there was a little confusion yesterday, and I want to make sure that you guys are clear. So first, let's just talk about what triggers are. Triggers are moving averages. That's all they are. They're just moving averages. And when I have a moving average, price tends to pull away and then back to that average. And there's a mathematician thing that says something about it's It's called like the regression of the mean or something. I don't know. I was an English lit major. But what happens is these trigger lines become correction points. This is where I expect the market to retrace to. And on your small chart, we're going to use two. We're going to use the large triggers, which are the 5-1 large triggers, the same ones that we use to determine momentum, that same space between the two to create momentum. But what we're also going to do is we're going to take these synthetic triggers. They're stepped. These are the large triggers from the large chart. These are the large chart, large triggers. Why do we do that? Because when they trend one on top of the other, when these correction points are stacked, snakes riding piggyback, what you're saying is that my correction point, not only on the large chart that leads the way, well, it lines up perfectly with my correction point on the small chart. And guys, this isn't your entry. The triggers aren't your entry. We're going to stuff some areas into those trigger lines. We're going to put fibs, midbands, yellow 1-to-1s inside of those trigger lines. And what we're doing is we're giving the market something to bounce off of right at the correction point. So large and synthetic, one on top of the other. There can be one area. Great question, Kenny. And I'm about to show you a picture that shows you exactly that. I love it when there's one area, less room for potential bounce. But let's go through the process real quick, guys. The difference between favorable, stacked, and what we're going to call split. When you have split triggers, what does that mean? I have two correction points. It means that my small chart correction point and my large chart correction point don't necessarily line up. It creates indecision. It creates more space where the market may retrace to. So for the brand new user, the tighter the triggers are one on top of the other, the smaller the window, the smaller room there is for an area to bounce off of. As soon as those things start to split, guys, it creates indecision. For the brand new user, this is your best look. For an experienced user, a chart reader, you're going to learn when it's okay and how to take these with split triggers. But let's define our window real quick. You know, I do this one every day. I'm going to go to the spreadsheet and let's do a long today. What do you say? Rule number 1 says that I must have odds favorable momentum, that I must have small triggers above the large triggers, space between the two, angled in the direction of the trend. Ladies and gentlemen, do me a favor. Give me a Y in the room if you're with me. This is the best look for a market that is likely to continue in the direction of the trend. Awesome. And then I have to make sure that it doesn't reach Fibonacci resistance, that the top end of the most current bar has not reached an area. All of my triggers are above the previous area. Can you give me a Y in the room if you're with me? I have a clear path. I have both momentum and a clear path. Guys, this is the precursor for the highest probability trend trade. It becomes even stronger when it comes from a reversal at a Fibonacci area. When price reaches support and none of the triggers break, and then that termination reverses the market, guys, this is a strong bottom. This is a good bottom. This sets you up for that highest probability trend trade. When decisions are made that can reverse the market, none of the triggers get through, guys, this is gold. This sets you up for everything. So everything says up, the path is clear, and I turn my attention to my smaller, faster chart. And I'm saying to myself, you know what? Rule number 3 says that I'm going to buy or sell a pullback at an area inside a favorable large trigger. So let me find my triggers, right? Let me see if there's any areas. Cool. But I'm going to buy a pullback. And that pullback begins with a reversal bar. The reversal bar is not your entry. The reversal bar is the beginning of the fight. The reversal bar is the beginning of a pullback. And a pullback is nothing more than a small retracement counter to the underlying trend. Remember, what happens in one bar here, we're going to get 15 to 30 on the smaller, faster chart. Thank you for that, Grant. News in 5. Once I get the reversal bar, guys, this is where you're going to pinpoint where the market is most likely to continue. The first thing you're going to do is you're going to identify your trigger lines. The large and the synthetic, and the tighter they are on top of one another, man, the better it is, because the less room there is for areas to be inside. So once you find those triggers, let's find the areas. Whoops. And the areas are going to be fibs, mid-bands, yellow 1-to-1s. And guys, this is such a key part. They are inside of the trigger lines, inside of the trigger lines. So once again, the more distance there are between the triggers, the more opportunities, the bigger that window is going to become. But when your trigger lines are overlapping one on top of the other, you can see that your window of opportunity where the market is most likely to continue for a long trade will extend from the highest point of support, fib, mid-band, or yellow 1-to-1, doesn't matter which one, to the lowest point of support, fib, mid-band, yellow 1-to-1, doesn't matter which one, inside of favorable large triggers. And this black box represents exactly where the market is most likely to continue. And you're going to be able to do this through repetition. It's still just a reversal bar. It hasn't even come close to it, and you already know where the market is most likely to continue. So you're just going to activate a limit order right at the top of that window. Why at the top of the window? Because the large chart has odds favorable momentum. Because the large chart has absolutely nothing in the way to create a bounce, I'm not expecting that market to rail through there, to drop below. I know that the small crowd is going to try their hardest, but the reality is they may not be able to push much lower than that. So my limit order goes right at the top. And if it comes back and hits that order, I am in an advantage-laden trade. And guys, this is it. Define your entry. When the large chart rules are met, wait for the reversal bar. But Mark, there's a divergence. Who cares? Momentum is established, and it takes 3 divergences on a high probability trend trade to keep me from taking the trade. Identify your triggers. Find the areas within. Create your window of opportunity. Once you guys can create a window of opportunity, you're there. That's it. You've got the high probability trend trade. The only thing left to do is activate a limit order right at the bottom of it and pray. And hope that the small crowd can push. Hope that the small crowd can get back there. And if they do, you're in a short position. Notice that on the large chart, it's still odds favorable and clear path. But on the small chart, there's like 8 or 9 bars against it, right to the best of the best spot. There was a divergence, doesn't matter. Small triggers turned against me, who cares? Momentum is established over here. Guys, I'm in a short trade with odds favorable momentum, nothing in the way, and in an area for entry, the best of the best, the point where the market is most likely to continue. This is the trade that typically wins 70 to 80% of the time. This is the trade that creates an enormous amount of confidence through the memory of success. This is the trade that typically makes it to the targets. This is the trade that manages risk before it ever manages profits by having momentum with nothing in the way. And guys, once you can pinpoint where the market is most likely to continue, you know where to put your protective stop. Down here below the window where the market shouldn't go. Because if it continues through, guys, you've lost your edge. You've lost your advantage. The statistical advantage is no longer present. You will take losses. Let me say that louder. You will take losses. Anything that wins 70 to 80% of the time is forced to lose 20 to 30% of the time. It's the cost of doing business, guys. We're letting the market be wrong. But if the market heads off in the direction, you're going to use those reversal bars. The same way this one told you where to find your entry, this one says reduce your risk, get below that reversal bar. It's doing everything it said it was going to do. And it's not uncommon to take small losses. Rather than taking full losses, very often, even when trades don't work out, you can take a smaller, lower tick loss. But you've got to learn to use the 2 charts. This is your chart reading. This is your foundation. This is the basis of all the good stuff, guys. When the large chart says up, when the large chart says clear path, we don't trade the tails. We don't wait for the tails. They are long gone. We trade an area of support inside of favorable large triggers. But I can go back and study. If I go back on my large chart and just circle tails all day long, when the rules are met, if they line up with support inside of favorable large triggers, if they line up with resistance inside of favorable large triggers, well, then I know I have a high probability trend trade. Guys, this is my trade. This is what I'm looking for the first 30 days. You'll be able to do it for longs. Reversal bar begins the pullback. I don't worry about divergence. Does everybody see how the large triggers and the small triggers are separated? that there's space between the two. This is the exact odds favorable momentum look that you'll have on the large chart. That's like the double whammy momentum everywhere. I use the red box. These are my trigger lines. The blue box are the areas of support. Here there happen to be two, so my window's a little larger. My limit order goes right at the top of the window, guys. I don't worry about support outside of the triggers. They're beyond the correction point. And then Kenny, for you, wait for the reversal bar, identify the triggers. Sometimes there's only one area inside of the triggers. I love that. It means that I've got the smallest window of opportunity possible. The trigger lines are one on top of the other. There's only one line inside, guys. My limit order goes just below it. And this is perfection. This is what I want to see. This is outstanding. It's even better when they just overlap and create one big ugly line for the market to bounce off of. And guys, this is your first 20 days with me, first 20 trading days. Be able to identify where the market is most likely to continue. When you do that, it means that you know where the market shouldn't go, and that's where initial stops go. And then once the reversal bar prints, you reduce even more. And guys, you can take this very simple concept, getting in at the area inside of favorable large triggers, moving your stop below the reversal bar. And what happens is if this one doesn't work for some reason, if it is a cost of doing business, it's not unlikely to lose $40 or $50 instead of $250, $300, something like that. So guys, that's the high probability trend trade. This is what we talk about every day for a freaking hour. And if I go back, and this is crude oil coming off a termination, everything's up, potential to break. Let's see where that circle lined up, just for grins. Just for grins. It pulls back to support inside of the large triggers. Notice that the small triggers are down here. Man, that might be a little more risk than you wanted to give on it, but it still pulls back to an area, and maybe it's not the best, but it's still pretty good. The better you get, the more likely you are to catch that one and take advantage of it. And then it's 614. Let's go back and see what this one looked like. There's your first pullback, and look how it pulled back to the second correction point. Do you see it? It bounces off the first and then corrects to the second. That's split triggers, ladies and gentlemen. And look how a couple divergences kill the potential for that area to break. Look how divergence kills that area's potential to break. Divergence again, right at the fib, even though the smalls are through, and sure enough, it pushes up. Guys, you're going to begin to use this chart reading to create advantages. Price reaches resistance. The trigger lines don't break. Guess what? No more long trades. Of course it can. Because, Cindy, the recipe for a clear path has absolutely nothing to do with the strength of the market, right? It has everything to do with the small and the large getting above the area. That's it. Don't overthink it. I'm telling you guys, everything that we do is pretty simple. And then if price reaches an area, whether it's strong, whether it's weak, whether it is losing momentum or anything can happen, if price reaches the area and the triggers remain below, guys, look at how the market reacted. This is a real solid recipe to keep you guys out of trouble or to let you know when it's potentially good. And Cindy, here's the deal. If I do have the clear path, but my momentum isn't the best, and I still have an entry area, well, then maybe I take a medium probability trade. This is one of those looks where when we went back to, when we talked about momentum, let me go and find the picture real quick. When we talked about momentum, whoops, that's not it. Hold on, I did the wrong thing. Here we go. With a clear path, there may be opportunities all day long to get down there. With a clear path, it might be okay. But because you can speak to yourself in terms of advantages, you can understand when something is missing. You can understand when it's not perfect, and then you can make the choice on whether or not you want to take the trade. Here's one of the biggest things I see new users do is they don't speak to themselves in terms of advantages. They don't say, I have momentum, I have a clear path, I have an entry area. They say, I hope it goes up because the small chart looks like an entry area. And they just willfully give up 66% of their advantages. Or maybe they say, I have momentum, but it's directly into a termination condition. There are no entry areas, and they hope that momentum carries them for the win. And as soon as you can start talking to yourself in terms of advantages, well, then you can paint a pretty clear picture about whether or not there is a statistical advantage present. And that's why I encourage you guys. Talk about whether or not you have momentum. Talk about whether or not you have a clear path. And what it does is it keeps you from hoping the market goes up. And I think that's a pretty outstanding example right there. Trading into Fibonacci resistance. All the triggers are below. There's no reason to take that long trade. Not yet. And then sometimes, and this is why we don't trade the NASDAQ, as a brand new user, sometimes you have odds favorable in a clear path, and it gives you the perfect entry, and then it forces you to manage out through divergences. And guys, the NASDAQ is a different animal. And for you guys that are really trying to trade the NASDAQ because you see the more experienced traders doing it, man, you're really giving yourself a daunting task because the NASDAQ moves about 10 times faster. And if you learn your patterns on the small chart, life gets easy. So guys, I'm going to take about 5 minutes. I'm going to go stretch my legs. I always encourage you guys to do the same. We have, actually, I think news already printed. When I come back, I'm going to give you a plan. We're going to talk about a couple different things, and we're going to start looking at your pictures, guys. So I'll be back in about 5 minutes. All right, guys, let's get back at it. Termination conditions for the win, ladies and gentlemen. Excuse me, I'm so sorry. And this is where, guys, I'm telling you, this is where dividends get paid. If you go back and you take this picture, right? All I'm doing is I'm learning how to read my software. And if I type out, if price reaches an area and the triggers remain below resistance, above support, no trades into that area. What do you guys think? We have two perfect termination conditions going on. If you take this picture and you go to your spreadsheet and you take the link and you go to the 101 tab, and this is what we're about to talk about, you can drop it in there and put this under your little study. This is my no longs or shorts picture. And guys, I'm up to 20 right now. And I'm going to give you a little plan that's going to help you get good at this stuff. And I'm going to give you a little plan that's going to set you up and turn you into a chart reader. And that's what the beginning of the second hour is, guys. The first thing I'm going to give you is this right here. This is Chart Reading 101. I'm also going to drop a zip file in the room. And this zip file has a copy of my spreadsheet. This zip file has a trading plan, checklists, Chart Reading 101, everything that you need to be successful. The only thing that Nexgen cannot provide you is experience. The only thing that I can't give you is the repetition. You have to create that for yourself. This is the easiest way to get to where you want to be. This is the fastest route to becoming a chart reader. Take 25 pictures of each rule being met. Take 25 pictures of each rule not being met. Take pictures of that 50-50 look so that you can recognize it and never get suckered into thinking it's a clear path. And take 20 pictures of entries, windows of opportunities for longs and shorts, guys. You're taking the individual pieces. And the task isn't just to take pictures, because so many times we take pictures and we never look at them, right? Look at your phone right now. You've probably got 1,000 pictures and 900 of them you never went back and looked at a second time, which means they're doing nothing, right? But if you go through and you annotate your charts with the Ys, and that's exactly what we did. We didn't just take a picture and then put it in the termination conditions. We use the language. If price reaches an area and the triggers remain below resistance or above support, no trades into this area. And then you can even type, like, go even more. Rule 2 not met, not a clear path. Whatever you need to put to associate the look right here, right? To convince yourself that long trades into that area aren't advantageous. And, why are the triggers strong? Describe it. What's the advantage? What's it mean to you? And then even more so, why is it a termination condition? Express the recipe and talk about the disadvantage. The disadvantage is I don't have a clear path. I don't have room to my targets. Rule number 2 isn't met. And if you go through and you do this for 25 of each, it's pretty easy. You do that for each individual picture. Don't copy paste. The time that you spend typing and looking at it and posting it into your spreadsheet, what you're doing is you're creating this correlation between the look and the advantage, or the look and the disadvantage, and you're becoming a chart reader. And this accelerates the process. And then ultimately, you're going to piece together these looks to create a trade. So you're going to be able to say that with strong triggers, right? When the smalls are above the large, where's that picture? When I have the best of the best look of strength, and then I also have a clear path in that direction, right? Smalls and below are through the area. Well, then I'm going to look for an entry. And you're just going to piece it all together. And you're going to be able to get to that point to where you can take the individual parts and create a trade. On the large chart, how much distance would be considered enough room to the target? Great question. And let me show you a picture that answers that one. Let me answer this in 3 parts. One part will be interpretive dance. It'll be awesome. I've got the perfect picture for it. All right, you ready? Here we go, Kenny. I love this question because this is such a good question. Buying and selling pullbacks increases room. So as everything is going up here, from 05 to 13 is 8 ticks. So that distance is $80 worth of potential profit from the top of that bar. So that probably, Kenny, you're saying to yourself, man, I'm not taking a trade for 80 bucks. What on earth are you thinking? But remember that we don't trade from the top of the bar, we wait for the pullback. So from 86 to 13 is $270 worth of profit, give or take. So for me, I'm calculating from my potential entry. So if I'm going to the live market, and I'm not taking a 50-50 with divergences, but if I am in here where there's 12 ticks to trouble, the reality is there's about 32 ticks to trouble to get there. So I'm calculating from my area of entry, and what I'm doing is I'm saying, is the $20 or the $120 risk that goes into this trade worth the 270 potential? Does that make sense? So that's how I'm calculating my profit potential. Only you can decide if that's acceptable or not. For me, that's more than enough. If I have $200, I feel pretty good about it. And then that takes us into if you are a tick off of a fib, right? Does that mean the fib is hit? In my experience and my understanding of how fibs are created, and let me show you how that's done. This is one of the things. I don't use bars, Kenny. I use ticks. I use money because I'm trying to make money. I'm not trying to make bars. Does that make sense? And I'm not going to lie to you. I don't even have a freaking idea. I don't know. This bar goes from 05 to 80. So that's a 25 tick bar. That's $250. But what I can calculate is that from 85 to 13 is 28 ticks. That's $280. And for me, that's reasonable because I know that I'm getting in down here. I'm not getting in up here. So I don't care how many bars it takes to get me to my entry. I don't care how many bars it takes to get me to my target. I'm only concerned about whether or not I have rules met and if there is room from my entry to my target to justify the risk. Does that make sense? I don't know how to think in terms of bars. Maybe I should learn because I've never had that question. The pullback typically, oh, hold on, I just reread it. Typically, Kenny, the pullback is one bar on the large chart, right? Because when we take the trades in a perfect world, that one bar retraces and it pushes all the way down to here. And then when price goes back up, so let me show you the dissection of a bar. Maybe that'll help. Let me show you that refinement process. I love these questions. So there's the one bar that gets us in, right? We decide that the rules are met here at the bottom of the bar. That's where the retracement happens. That's where the reversal bar happens. And then up here where it doesn't make a second bar, a third bar, it doesn't even create a reversal bar, that tail is the pullback to resistance inside of favorable large triggers. So I'm not calculating from 97 to 95. I'm calculating from 01 to 95 to my potential target. Does that make sense? So typically on your large chart, it's one bar, always. And then depending on the fluctuations, the ups, downs, I don't know how many bars it would be to get to the target. Does that make sense? Did that answer your question? I hope. Typically your retracement, okay, cool, is like 20 to 30 bars in there. So And then I'll go ahead and do this, guys. This is how your fibs come to be. When you open your software, your software runs thousands upon thousands of calculations, every move in the market, every up, every down. And it creates all these Fibonacci retracements and stuff. So your Fibonacci areas are areas, guys. There may be 175 fibs right here between 1 and 1.5, right? And then right in the middle is where that biggest consolidation, and that's where the fib shows up. So all of these calculations create these blue lines. They create these red lines, which is why when I'm using fibs, if I'm a tick off, I'm in that area. I feel pretty comfortable not trading back into it. If I'm 6 ticks off, 5 ticks off, even 4 ticks off, well, then I start going, all right, if everything's right, I'll take the trade. These yellow 1-to-1s are singular measurements from just a couple pivots. They are exact numbers. The divergences are exact numbers. So that's one of the things to take into consideration when you're trading is the fibs are areas. And look at that, man. It didn't break. Gave up momentum, and look at the bounce. The fibs are areas. But the yellow 1-to-1s, the divergence lines, those are exact. Those are 100%. So sometimes if I'm trying to say to myself, see how it overran it by a couple ticks? They're areas. Good stuff. Thank you for that. Where was I? Chart reading. Don't skip it. That's the one that pays dividends. And then let's go into the plans, guys. Let's go into the KISS plan. All of you business people know what KISS means, right? Keep it simple, sunshine. Keep it simple, silly. Keep it simple, studious people. Guys, this is a stepping stone. This is you having something to follow as a brand new user. This KISS plan is designed to optimize your chances of success. This KISS plan is designed to turn you into a chart reader. This KISS plan is designed to give you a way to be profitable as you continue to learn the software. This is a plan that creates a statistical advantage, and it optimizes your chances of success with the high probability trend trade and the 50-50 trade as a new user. So through simulation, through study, through class feedback, and continuous practice, you're going to create your own plan. You're going to create a plan that suits your needs. Maybe the high probability trend trade isn't your jam. Maybe you really love momentum trades. And that's cool, right? You're going to know that once you start reading these indicators, once you start recognizing these patterns. And you will create your own plan, but this gives you something to focus on until you're able. If you are coming back to my classroom, and guys, I recognize a lot of names from the past in here. If you're coming back to my classroom because you're not as consistent as you want to be, if you're coming back to my classroom because you find yourself trading opinions rather than rules, if you find yourself making the same mistakes over and over, one of the best tools that I've used with people that come back to me and they're looking for help is go back to the KISS plan. Give it 5 days. And if you can follow this plan for 5 days, history shows that you're probably going to be successful, that you're probably going to win more than you lose. But the key is you're realigning your ability to follow rules, to insist on those advantages. Adriana, you warm my heart when you miss me, especially if you tell me that you miss me. And it's great to have you guys back. But if you're back because you're struggling, let me help. So often people decide that, well, now I'm doing this prop firm. I probably shouldn't post in class because I'm kind of a big deal now. I'm trading live money now. I'm not going to bother marking class. I've had software for 3 months. I don't want to take up class time. That's for new people. Poppycock, I say. Guys, this is your class. If you are a Nexgen client, this is your class. I don't care how long you've been with me. I don't care where you are in your trading. I'm excited to see what you're doing because maybe I'll learn something. Maybe someone else in the room will learn something. So make sure that you're staying active in the education, guys. You have a coach that wants to hear from you every day. So your simple plan for consistency, no matter where you are as a trader, man, and you do, Ron. I'm going to have to shave my hair. I'm going to have to shave my head too. My hair's going quick, and I think it's your fault. The simple plan for consistency, don't fight the large chart, guys. don't be this egomaniac that has to be first. Don't be this fortune teller that has to predict. Fighting the large chart is one of the biggest challenges that new users have. Fighting the large chart is the biggest reason that people end up losing money, especially as a new user, because we get excited. Um, Fighting the large chart is how to commit financial suicide, and it's maybe a crass way of saying it, but this is the easiest way to blow out accounts, guys. Trading against strong triggers, fighting the trend, trading into termination conditions. If you can harness your patience and avoid these simple mistakes as a brand new user, guys, you're going to find that you're already ahead of like 70 to or 80% of the average day traders. And if you're fighting strong triggers, you're fighting the trend, and that's a big deal. You know, my brother had a buddy that was a broker. Excuse me. And this was probably 20 years ago. Excuse me, one second. All right, the allergy game is real in Texas. And this broker told him, "Hey, John, I finally figured it out, man. I know exactly how we can get you $1 million in your account." And of course, my brother's like, "Great, let's do this. Let's make this happen." And the broker goes, "You shave it every day, Paul?" "I'm almost there. I'm holding on. I'm holding. I'm 52 this weekend, and I've been on testosterone for 15 years, and I'm surprised that I still have hair. I'm not gonna lie, but I still can't push out a beard, so it doesn't seem fair." Um, but the broker says, "Hey, thank you. Let's get you to $1 million." And my brother goes, "Cool. How do we do it?" And he goes, "Man, I want you to fund your account with 3 million. And I want you to fight the trend every chance you get. And I feel like by the end of the year, you should be down to 1 million." And they have a good laugh. And it's this funny little joke, but it's true. Everybody that trades the market understands that fighting trends is not advantageous. So don't fight it. And then define your entry, personalize it, make it yours, guys. Believe in the fact that this is your trading plan, that this is your path to success, that these are your rules to run your business. And when you make them yours, hopefully you're less likely to break them, because they're not my rules. They're not Adriana's rules or Cindy's rules. They have nothing to do with JW's rules or Donna's rules. Haji can't write rules for you guys. You're doing this yourself. So this is your plan. Personalize it. Write your name at the top. Define your entries. That's the key. Great entries create manageable trades. And once you can define your entries, guys, everything falls into place. This checklist is a checklist. I'm going to give you another one too, that I've never had anybody follow it to the letter. I've never had anybody be able to mark yes truthfully and do worse than 70%. And I want that to ring in your head for a second. Nobody has ever followed this plan to the letter and done worse than 70%. It's usually closer to 85, 90, but let's keep it as promise low and exceed expectations or whatever. And if your goal is to get paid, doesn't it make sense, at least in the beginning, while you work things out, to focus on something that wins more than it loses? And then for you guys that are brand new, here's the exact same checklist. And what it does is it says, this is a good top or bottom. And it even gives you a video to watch. And it reminds you, you can take it without a good top or bottom, but you've got to manage it a little more with those divergences. But this is what it looks like. It's a no triggers through termination that reverses the market. Oh, it's not yet. I still have a few days in my glorious 51s. Here's your odds favorable. There's your odds favorable. There's your anything can happen. There's a termination. There's a clear path. There's the potential to break but not broken. And then there's your windows of opportunities, guys. And what you're trying to do is you're trying to mimic these great looks in every trade that you take. You're trying to mimic these advantages every time you take it. You're committing these amazing looks to memory individually so that you can come back and piece them together and turn them into a trade. And you're looking for these not just in the moment, guys. So many people think that they're going to learn to be day traders by taking trades. And I'm going to tell you right now, that's like believing that if you go play golf every day, you're going to become a better golfer. Golfers are made on the driving range, guys. Home run hitters are made in the batting cages. Basketball players that shoot a lot of hoops, and I don't know what you call them because I don't watch basketball. They're made during practices. They're made during training. They're made during building muscle memory. So back off of the live trades every now and then. Back off and say to yourself, let's just look for advantages, right? Let's look for advantages historically. And let's begin to recognize termination conditions and odds favorable. And let's say that when the market comes from a pivot stop out, it's more likely to go up. And let's build these great habits in the beginning so that you can become an awesome trader in the end. So that one's got pictures. Study it every morning. That one, you can print it out. Which one? These checklists and everything, Paul? These aren't. These are things that I create for you guys. There's a zip file with each of these checklists in it. So it has this one with the pictures. It has this one to print out and put on your desktop. And then it also has the KISS plan in there. Yeah, the one with the pictures is in that zip file. And then if you're not a zip file kind of person, here's all the Word documents that I just shared with you. And if you guys ever have problems getting them out of the room, let me know. I'll email them to you. But the one with the pictures you're using not only to know what you're looking for, but also to police yourself a little bit as you begin to take those pictures and fill out your spreadsheet. And here's the best part about it, guys, is once you can define where the market is likely to continue, once you take that entry, once you build trust in it, you're going to have to manage it. And for you new guys, for you emotional roller coaster people, you know who you are. For you folks that move stops too soon, that move targets because you get scared, for you people that jump ship even when everything is going great, the same way a mechanical entry tends to pay dividends for the new user, a mechanical approach to management does as well. So for the brand new users in the KISS plan, this is the most basic management plan that I could ever come up with for you. And it's effective. But you will create a plan tailored to your personal goals based on your ability reading the indicators. But in the beginning, everything stems from finding the point where the market is likely to continue and taking the correct entry. And once you take this entry, the only thing for you to do is put a stop where the market shouldn't go. 4 to 5 ticks beyond the window of opportunity. And then you do nothing. And you're either stopped out, and that's cool. I want you to learn to be okay with losses. But I want you to only be okay with them if the rules were met going into them, because you know that if you take this trade 10 times, even if the stop gets hit, that's just a normal part of it, guys. The next 7 or 8 are probably going to be winners, or at least those averages working their way out. And then once the market gives you a reversal bar, which it will do more often than not, reduce your risk. Very often I see people, even after these reversal bars, keep $200-300 of risk on a trade. There's just no reason to. You're better than that through your chart reading. You've pinpointed where the market is likely to continue. The market's doing everything that you wanted it to do. Get that risk down. And then there's nothing to do until it either hits your target or stops you out. But if it hits your target, guys, that's $100 in the bank. That's $100 in your account. It's closed out. The contract's closed. It's yours. They can't take it from you. And that feels good. This is where the palms start to dry up and those butterflies go away. And you're like, man, there's something to these entries. I'm beginning to develop trust. I'm losing my distrust in selling the market as it's coming up at me. That doesn't seem so scary anymore because I keep getting paid on this one more often than I don't. And then you're going to move your stop to break even. And you're going to say, not only did I get paid, I've got nothing to lose. I've got nothing to lose. And guys, this is the equivalent of just fearless, believing that the large chart's going to push and having nothing to risk. And the cool thing is that if it hits your second target, it's not way off in the distance. It's not a home run. It's a $200 target, which means that on one trade, if you hit both targets, it's a $300 trade. And show of hands, who thought when you signed up to be a day trader that you would make that $1 million in the first week, right? I can't get rich off $300. Hell, I make that every day anyway, without even day trading. Why would I worry about $300? That's just ridiculous. It's only 2 contracts. I need to trade 10 contracts to get rich. I need to hold for giant moves to get rich. Guys, $300 a day on 2 lot is a $1,500 week, and that's a $6,000 month. And that's a $72,000 year based off of one trade going the distance. I mean, holy smokes. Turn that 2 lot into a 4 lot with the exact same entry and management, and suddenly you're at 144,000 for the year. And you're like, wait a minute, there might be something to base hits. Guys, if the best you do is $100 a trade 5 times a day, that's $126,000 a year based off of $500 a day, only $250 per contract. It's not about hitting home runs every time, guys. It's about taking the trades with the statistical advantages. It's about taking the trades that have been proven to win more than they lose. It's about understanding what your charts are telling you so that you don't forfeit the best of the best, because this is a business. This is an investment. This is not a video game. This is not your adrenaline fix. Go swim with sharks. Go jump out of a perfectly good airplane, right? Go pick a fight with a Hell's Angel, whatever. Let that be your fun stuff. Let your trading be pragmatic. Let it be methodical. Let it have advantages. And then once you're good at this, once you can define these entries, once you understand these advantages, you're going to move to the 50-50 trade, that medium probability trade where the clear path is gone. And this is the best of the best way to take it. This is the most lost trade with new users because they abandon the idea that without a clear path, momentum is key. They abandon the idea that favorable large triggers is better or is worse than or better than split triggers. So this 50-50 trade needs to be from a good top or bottom. It needs to be from a termination condition that creates a full reversal. Why? Because decisions were made that reverse the market, guys. And if you don't understand a good top or bottom from the high probability trend trade, well, then you are ill-equipped to take a 50-50 trade. You're not there yet, needing to work on your chart reading. It requires odds favorable momentum on the large chart. Once again, if rule number 1 isn't your bag, if you're not good at it, how are you going to take a medium probability trade without being able to recognize that momentum in a moment? And this one's even more important. Recognizing momentum on the small chart, knowing that the large triggers and the small triggers create that momentum, not the synthetics. And then it reminds you and it tells you that if divergence is lost on the 5-1, what does that mean? Does anyone remember what divergence means? It means that there's no momentum. It means that the momentum is slowing, that the momentum is going away, that it's being forfeited. Guys, if I don't have a clear path already, why on earth would I sacrifice momentum and expect to win? Why on earth would I give up the perfect entry area and expect this trade to be profitable? And I want you to keep that in mind. Divergence just means loss of momentum. Perfect, Paul. We're already down 33% of the advantages, guys, so don't forfeit that momentum. Don't give it up. And then enter at the area if you can mark yes to everything. This is the best of the best. They optimize your chances of success. And then you have to manage it a little differently. But notice that it says divergence, no trade again. Notice that it says if divergence prints, exit the trade. I mean, that's 3 times, guys. What do you suppose is the biggest mistake that new users make? Maybe it revolves around divergence. And I took a picture this morning. Actually, I took a series of pictures. And I want you guys to see this. This is not a no triggers through termination condition, guys. The smalls get through the divergence low. They made it through support. This is just a pivot stop out that reverses the market. It's still a termination condition, but the triggers made it through, which means it isn't a strong bottom. And I've made something yesterday for you guys on that. So this trade right here, guys, give me a Y if you see it. It's a 50-50 trade. Smalls are through, large are below. Does everybody understand that very basic concept? So let's go through it. There's a divergence on the small chart. That's strike one. The smalls are working their way inside of the large on the small chart. That's strike two. My triggers are split, which means double the correction point. Holy crap. I'm giving up advantages everywhere on an area that's not even broken. And it's not a good bottom. Guys, these are all the problems that I could find with this trade. This is my chart reading. And then here's the deal. A lot of you are going to say, but Mark, look at the momentum. But Mark, look at the area right there at those triggers. I'm going to take this trade. And this is where you guys do it. You're like, I know that it wasn't right, and I know it didn't break the rules, but I really want it to go up because, you know, I want it to go up. I want to get a winner. I really hope that this one works. And then my father-in-law's brilliant words. Wish in one hand, shit in the other. Tell me which one fills up first. Guys, trading isn't about hoping that things work out. Trading isn't about like witnessing advantages going away and then expecting something different to happen. Trading is about trading high probability scenarios. Day trading is about having a statistical advantage every time you get into the market. And no matter how much I wanted that market to go up, guys, it didn't even come close to following the best of the best. And I took that picture this morning and I went through it and I was having a blast. And I was like, this one better not win, just to make me think that I can break my rules. And it didn't. The market just railed down from there. So when I talk about your best chance of success, guys, that's the KISS plan. When I talk about optimizing your chances of success, that's the KISS plan. And until you find yourself in a position where you're winning more than you're losing, oh, pissing one in. Yeah, I guess either works. I guess my father-in-law was a little more crass than you. He was awesome. Yeah, you got flagged. That's all right. I'm not kicking you out, Paul. We like you. I always heard it poop in one hand and tell me which one fills up first. And you know, I've never heard anyone else say it, so I like that you know it. Keep it simple in the beginning, guys. Keep it focused. Keep it just registering the absolute best of the best. And what you'll find is that your results follow. Your results are not a wish for things to work out. Your results are just following a plan. So I've been talking lots. I'm going to go through and I'm going to start looking at pictures, guys. And I noticed that there's not a lot today, which leads me to believe that FOMC Day is doing its thing. So we're going to start. Paul, I don't know when you sleep. We're going to go through your pictures, and I'm going to go through them, and we're going to have a couple good lessons, Paul. There is going to be a lot of praise for you for a second, and then I'm going to kick you in the clackers kind of hard as well, because I think that it's important that we have both. So I'm going to put you through the ringer because you're going next level on me. You are going outside of the basics. You are turning into a chart reader. And guys, this is where adherence to plans pays dividends. So, not a good bottom, right? But you do have momentum. You don't have a clear path. And this is that one on the small... Yeah, sorry, Paul W. These are Paul W.'s charts. You have two divergences. And Paul, you made a calculated decision to take the entry. You used... I would be flagged, but I have the microphone, so it can't flag me. I should be flagged about 1,000 times a day, guys. Paul, you take the pivot stop out, and you trade the pivot stop out. And you trade it on the way up, not the way down, because you know it's not perfect. I love this trade, and I like that you used areas for exit. And I think everything about this trade makes sense from a chart read. With that much momentum, with strong triggers, with a tiny window of opportunity, with your risk already established, let's see if it keeps going up. Because it was a pivot stop out right at 1-to-1s. That's a good look. And then as this one continues, I want you to see something else. Now we have the triggers are weakening, right? They barely made it through resistance. You have divergence straight from a fib. You have just smalls against you getting below the large. That's more divergences. And you said, you know what? I'll go up again. And you're taking a pretty risky move here. Because at this point, guys, when we talk about 50-50s, let them smash with odds favorable. That's why this one was effortless. Here you're seeing a visual slowdown. It is ugly. You've got weak triggers. You've got divergence. You're beginning to spread out. You take it and you manage it beautifully. And you get out of that trouble that doesn't show any sign of breaking. And then you said, well, it turns out that I'm pretty freaking indestructible. So even with 3 divergences in the same price range, even with weak triggers, even in an area that's not broken, to hell with everybody in rules, I'm going to go long anyway. Maybe because I'm doing market replay and I remember this one. Paul, you're trading against 3 divergences. You're trading against an area that's not broken. You're trading with so much ugly on this chart, and it rewarded you, and it made you get lucky. And these are the ones, guys, that you have to say to yourself, even though I remembered it, even though I know it goes up, Paul, you ditched everything. You traded into a termination condition on a 50-50 with weakening triggers. Your trigger lines don't even agree. Do you see how that one is? And it worked. And guys, I told you that I'll tell you if you get lucky. And you got lucky. This was your last ditch attempt before that second lower. This is the one that I think you remembered that it went up. And if that's good, that's, whatever. This feels good because it grows the P&L. One of the best ways to use market replay is pause, pull out your rules, and then absolutely insist, Paul, rules met versus rules not. And if you find an instance, right, where 2 divergences on a 50-50, then your job as someone taking this investment, as somebody going in, Paul, what you need to do is you need to go back and see how many times 2 divergences on a 50-50 wins. And you need to go back and see how many times and make sure that you have a statistical advantage. Because I can tell you this one doesn't have it. This one is maybe 50% at best. That's really the one with those strong triggers. And the cool thing is that you don't need these to be profitable. Wouldn't you agree? That you don't need these maybe trades to find your goals every day. That's hard. That's hard to remember. So you have a 21 with strong triggers, but you're directly in determination conditions, 100%. And there's just no reason to take the long. And it wasn't an easy 10 to 20 ticks. It was financial suicide. Everything was wrong with this chart. Nothing was good about your entry. And to say that because it went up, it was an easy 10 to 20 ticks is setting yourself up for long-term failure. I hope that makes sense without sounding ugly. And then the 2024 setup that you're looking for, Paul, is, and guys, this is kind of cool. In 2024, Nexgen had a trading plan. I'll see if I can get my brother to send it over. Or the 2004. Is it said, and guys, this was 20 years ago. Put your big boy panties on. Is that when a termination condition, when the market stops at a fib and the small triggers roll and come down hard, Paul, the 2024 trade was looking for a pullback to those small triggers. It typically corresponds with a pullback to the large triggers. So this one never set up. What you had here was triggers up into a termination. You did have that pivot stop out, but until the roll happens, it was low probability because look, there's the first one and it doesn't work. There's the second one and it doesn't work. Pushes up again before it finally goes. And do you notice how everything rolls now? Now we start looking for those opportunities. Y'all's ability to recognize and see this is going to keep you from going too soon. And I'm going to show you one of my favorite pictures that I've ever made for people. Because I had a guy that loved to trade. He loved to be first. I happen to be a guy that loves to be first, and it eats my lunch every now and then. This is the picture that I call might versus has. And this is helpful for a lot of us. This is using a range chart, but the idea is exactly the same on a 5-1. When everything is screaming up into resistance, there's always a couple of us that say, that's a red line, I'm going short. And if you've never done it, you probably will. And if you go short right at the red line, you might get stopped out, and then you get stopped out again, and you get stopped out again, and you get stopped out again. Has anyone else ever done that? I think this red line's going to hold, so I'm going to go short. Well, that didn't work. I bet it holds this time. Well, I'm pretty sure it'll hold this time. Well, it might hold this time. And I see a lot of people lose a lot of money in this look, but here's something pretty cool. The price where you get in, hoping resistance holds, when your trigger lines roll, when the smalls get below the large, it's almost always the same price. It's the neatest phenomenon ever. So when you get these indecisions at key areas, when you get these terminations, these pivot stop outs, a lot of times your small chart will make that roll and say, all right, let's go for it. It typically happens after a second low or a third divergence. And a little bit of patience keeps you from getting run over too terribly much. And it keeps you saying, man, not yet. We're getting there almost. Let me get my large to roll. Hell yeah, let's go short. And man, it's such a great patience piece. And then Paul, this is a great example of it. And this is such a great picture because there's your termination. And look at the dance that it does for, what is that? Almost 50 minutes. The market goes bing, bang, boom, bang, bing, bang, bing, bang, boom. That's the Boss Rutan way. And then once everything rolls, I bet you that's where that thing started down, right? So it's easy to say, I'm going to go short with this divergence. I'm going to go short at this pivot stop out. I'm going to go short and hope right here. And man, I love this picture, Paul. And I think you did everybody a huge service by posting it because that's pretty common. This desire to be first, this desire to be the first one in, to show everybody how smart I can be. And the reality is these guys have to turn it. These guys have to kill the momentum. These guys have to react to the area. And then being that little remora that I am, it makes life pretty easy. So great pictures, Paul. Thank you. And guys, those were posted yesterday. I'll always go back and take a look at them. 50-50, strong triggers, good bottom, one divergence, perfect entry. And then that was your exit condition. And it got you. Did that one win? And it's okay if it did. But do you see how one divergence, and let's go through the math of it. Oh man, I got you. The math of it is you're in at 80 and the market goes up to about 95, which means that from here to here, you're already paid and break even. And then when second divergence prints, it's money in the bank on both of them, and it becomes an easy trade to get paid on, as opposed to one with mounting problems. Does that make sense, Paul? And sometimes we're just not in front of the market at the best spot, and that's where people like to make mistakes. Man, I missed that trade. I wasn't in that trade. I should have had that trade. And it's this falsehood that every move is your move, that every dollar spent or earned or made in the market belongs to you. And guys, there's like $220 billion traded an hour. You don't have to be in every move to get paid. You don't even have to make $1 million in a day to be a successful trader. But let me go through the chart read. When you have a termination condition and it's a pivot stop out, and two divergences print from the fib, Ron says, you know what? This is the perfect recipe for an untradeable bounce. So I'm not going short. I'm going to go up to where everyone else is going short because the people that are reacting to this know exactly where you guys are hoping to go short. Ron, I love everything about the chart read, even though it gives me heartburn. And then when that divergence, that pivot stop out, comes through and it prints an even higher divergence, Ron says, hell, there's nothing in my way on the right side of everything. Let's go to fibs. And he gets paid again. And neither of these are high probability trend trades. Neither of these are even, well, the second one might be with the trend. The first one fights momentum, it fights direction. But once you're a chart reader, you're going to start seeing opportunities, guys. And these financial suicide trades turn into very calculated trades. And they both showed up while learning the high probability trend trade. Thank you for that. Why? Because if you don't understand termination conditions, you don't know to look for a trade. And if you don't understand that two divergences from a fib can create a big ass bounce based on management, you don't think about getting in. And if you don't realize that when it pulls back with that best of the best look, that you're probably going to make it at least to the mid band, if not the first area of resistance. So it all comes up. And guys, the high probability trend trade is not designed to tie you down to one trade. It's designed to make you realize all the patterns that repeat themselves in the market and to be able to speak to yourself in terms of advantages. Great trading, Ron. And then Paul says he wants me to check his bottom. Weak bottom because the small triggers broke. Absolutely. I agree 100%, Paul. And then it's not a high probability trend trade, right? At this point, Paul, there's your 2004 trade. Do you see it? There's your 2004 trade. When a termination, the small triggers come up strong, the pullback to it. That's it. That's your 2004 trade, Paul. Does that make sense? When a termination, the small triggers ramp off of it, pull back to it, using the small chart to give yourself something solid to trade off of. That's it. Nexgen started. So, Paul, you know Nexgen's been around for 27 years, right? For 27 years, we've been teaching people to read indicators. We've been teaching people to trade. So all the way back in 2004, Nexgen had a trade, and it said, let Fibonacci reverse the market. When the small triggers roll, use those for an entry point. Yeah, the year 2004. Sorry. And I mean, this is where are we at? We're in 2024. 20 years later, the pattern is still repeating itself. So when you talk about a statistical advantage, is it a high probability trend trade? Absolutely not. But what it is a recognition of a pattern that's been repeating itself for decades, and Nexgen users are still getting paid on the look. And this is the stuff you guys have to look forward to. If you're brand new, all this stuff that doesn't really make sense just yet, that you're like, man, I didn't see that in the moment, you will, because the more you study the high probability trend trade, the slower the market moves is the easiest way to say it. The more you look at it, the slower the market goes. And then Andy, thank you so much for posting this. 50-50 from a bad bottom with divergence, and it stopped out. And Andy, you said, what did you say? Managed to get a little, got a little bit. You got a little bit because you broke your rules. So can we agree, Andy, I don't know if you're in here, can we agree that you got lucky to get a little bit? When everything said this trade was likely to fail, you took it anyway and made $60 per contract. And what your brain is saying is, hey, Andy, guess what? You made $60 a contract. That's $120. Andy, you made $120. F your rules. I'm sure this is a way to get paid. I'm sure breaking all the rules is a great way to be consistent. And guys, your mind's going to mess with you like that. This is why I talk about rules so much, and this is why I'm so adamant. Know what your rules say, and begin to train your brain to find them, to follow them, and then you will grow beyond it. But there's got to be a point where you say, I'm giving away everything. All right, strong triggers, beautiful. Is it a high probability trend trade? Great question, Paul. So let's go through it. It looks like you had a 50-50 that didn't work there. So what you have is you have odds favorable momentum, right? Smalls and large are below. You have a clear path. Are you comfortable with that? Once you get below this resistance, you have both strong triggers and a clear path. That's pretty easy to recognize. You good with that one, Paul, so far? Paul Flowers? Sorry, Mr. Flowers. Or even if you're not, is everybody good with that? Once the large triggers get below, there is odds favorable and a clear path. We can say without question that rules 1 and 2 are met. Rule number 3 says that I have to wait for a pullback to an area inside of favorable large triggers, right? That's the high probability trend trade. Not sell it, right, arbitrarily, but wait for the pullback. That's what the high probability trend trade rules say. That's what the trade that typically wins 70 to 80% of the time says. That's what the best of the best is. So was it a high probability trend trade? Well, it wasn't. Not at all. But what it was is odds favorable momentum on a clear path, momentum on a small chart, and there are traders that take advantage of this look and saying, with this much momentum, with a clear path, I'm probably at least going to hit a blue fib. And with odds favorable momentum on this chart, let me see if I can make a little. So not a high probability trend trade, but very much so an opportunity once you become more of a chart reader. JW loves this trade. Ron loves this trade. And then down here, we get those weaker triggers. It's a 50-50. 2 divergences print, and that says don't take that next short. A lot of great chart reading on here, Paul. But not a high probability trend trade because rule number 3 wasn't met. So this is where I encourage you guys over and over. And this is where I say it over and over. If you get in the habit from day 1 of writing each rule on the chart, if you use the language on each chart, if you literally say to yourself, I have to have an area inside of favorable large triggers on my small chart, well, then you begin to realize that that isn't a high probability trend trade, that it doesn't fit the rules. But that doesn't mean that it's not a potential. It just means that it's not a high probability trend trade. And if you start to recognize all that momentum carrying a market, you're going to find yourself in a position where you begin to incorporate that pattern into a trade. You'll be able to take 50 pictures of it. You'll be able to understand if it wins more than it loses, and maybe you adjust your trading plan. Termination, odds favorable, clear path. And then if you took this trade, Paul, you did have split triggers. And once again, there's really not a high probability trade. There is that termination reverses the market. Here's the pullback to the small triggers. You may not be there yet. You may not be at that point yet to be able to catch that. But I want you to remember this pattern, okay? When a termination gives me this look, these small triggers, maybe you find an area to trade from. Maybe you look for that opportunity to take advantage of the good top or bottom, and this works its way into your trading plan eventually. I hope that makes sense. So just because it's not your trade today doesn't mean that it can't be your trade next month. It doesn't mean that it can't be your trade in a couple weeks when you see these patterns repeating themselves. And that's all it is it does the same damn thing over and over and over. And Grant says, when I have a termination that reverses the market, that gives me odds favorable on a 50-50 with no divergence, I'll go long at a mid-band inside of favorable large triggers. And he goes from the lower point, not the higher point, because he's losing a little momentum. And Grant, you get paid easily on that one. And I got to tell you, guys, if you want to see the model of consistency, Grant has been it lately. Every chart that he's shown me for the last 2 weeks have looked exactly the same. Very little deviation in the conditions on the large chart. Very little deviation in the conditions on the small chart. Just repeatable patterns. And then Ron says, I'm not so much a trend trader, but Paul, here's that look. With momentum and a clear path and everything that says up, I'll take a chunk. And that's that chart read turning into the next one. And he said he got out in time right before news. But that's just taking momentum in a clear path and finding another way to capitalize on it. Great work, Ron. Great trading, Grant. And then Kenny. Termination creates the reversal. Momentum is great. There's those split triggers, right? Kenny, are you with me in here? And this is where language becomes very, 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 very important. Two correction points, right? You've got a high point and a low point. These are split triggers. And you take the point right in the middle. And I like it, and I think it's a good look. And I think your stop's appropriate too. I think your stop outside of those triggers is fine. So what did it do? It went beyond the correction point, right, Kenny? Are you in here? Did he leave? Does everybody see how the market went beyond the correction point? And Kenny said, if it goes beyond the correction point, I no longer want to be in that trade. And Kenny had a termination that reversed the market. And Kenny had odds favorable momentum and a clear path. And the reality is that they don't all work. They just don't. Kenny, great job. Great chart read. I love everything about it. You took the area just above the correction point, and when it goes beyond the correction point, you let it take you out instead of hoping. And man, every now and then these don't work. Every now and then you're going to take a loser. And I like this loser. I think you took a great loser. Does everyone understand that? Can you guys still hear me? It's a beautiful setup. The only challenge was the split triggers. It means that the correction points differ on both charts. He took a logical shot at it and put his stop in a good spot. Sometimes with split triggers, nobody can hear me. Am I muted? I just want to make sure. Oh, you know what? I'm not at the bottom, so if you guys are talking, I can't see it. That's funny. Sometimes with split triggers, people have been known to wait for a reversal bar before entering because the correction point is different. Sometimes people have said to themselves, it's not perfect on the entry. Instead of just selling on the way down or buying on the way down, I'll wait for like a reversal bar or something. Allegedly, there are people that use that for entry when it looks like this. But the large chart setup is rock star perfect. And it's just those split triggers a little bit, but it's totally appropriate. Everything about it. You just took a loser on that one. And then Don says, divergence from nowhere isn't great. Termination condition kind of sucks. And when it hits that resistance and nothing blinks, well, this is a market telling me that it's likely to go down. So what I'm going to do is I'm going to wait for every color on every chart to agree. And I'm going to take an entry right at the midband on that snapback to the small triggers. And I'm going to get paid at trouble. Don, I love this trade. When I say split triggers, talking about the large and the synthetic on the small chart is exactly what I'm talking about. Exactly, Mr. Flowers. Don, this is one of those next level. Because it's not a 50-50 trade. Not at all. It is a trade directly into support. Directly into support, and absolutely nothing has broken it. Not a 50-50 trade. What it is an absolutely beautiful indication that they want the market to go down. So it comes down, it hits support, it can't break it. The sellers fight back as hard as they know how, right to a key area, or the buyers fight back, and then the sellers take over again. So you had your reaction to support. It couldn't get above resistance. And what you did, Don, is you let everything on every chart agree before you took a shot at it, before you formed an opinion. And you said the reaction has already happened. Maybe you didn't, but you could have. The reaction to support has already happened. Resistance proved to be stronger. None of my triggers blinked. Everything agrees. This market's more likely to go down than up. Let me get paid. And these are those trades that confuse the hell out of new users, guys. Because this is where people say to me, but Mark, he didn't have odds favorable momentum. But Mark, he didn't trade with a clear path. But Mark, and guys, don't be the trade police. This is a chart read. This is resistance that stopped the market cold. These are large triggers that never rolled up. These are small triggers that never got above the large triggers. This is trigger line and color agreement on every chart to the downside, and Don just did what it said. I love it. And he did it from the business side of the fib. So Don, I don't know if you're listening, but what a great chart read. What a great way to take advantage of patterns that repeat themselves. And create opportunity for yourself with your ability to read the charts. All right, termination, it comes up, pulls back, another divergence, everything just keeps going up, right? The market reverses, you get that clear path, you do have odds favorable, and it pulls right back to the support right there. And then, Paul, two different looks here. Two different looks here, and I want to go through both of them. The first look is the momentum look, which is when you buy that little snapback because of momentum on both charts. This is what we call a momentum trade. This is, man, the termination, three divergences, everything rolls, the momentum goes up, and you let the market break through the area and then just buy a little snapback. And this is a momentum trade. Does that make sense, Mr. Flowers? So this is the trade where you say, if momentum gets me in, this is your little management point, then a loss of momentum is a swell exit condition. Man, then this may be your trade, right? This might be your trade. So check it out. Once price gets to the wrong side of those small triggers, momentum is over. So what you're looking at here, Paul, is you're looking at the ability to grab a small chunk, a little piece that's dependent on momentum. Does that make sense? These are not home runs. These are not trades that are 32 flavors of kick-ass. These are trades that are quick profits based on momentum and momentum alone. And here's the cool thing, is that when you lose momentum and the large chart says yeehaw, most failed momentum trades turn into trend trades if the market's going to continue up, which means your high probability trend trade knowledge, after you get paid here, says, you know what? It's split triggers. Maybe I wait for a good one from the lower point, and then it gives you the opportunity to jump in there. And there's your get out. I love it. And it's not a third divergence. This other divergence is from way off in the distance. So that's your second divergence. And notice that when the second divergence prints, everything still says up. And sure enough, it does go up right to the area. So there's actually two opportunities in here. There's the quick base hit, and then there's the second leg with momentum to get to trouble. Does that make sense? Good stuff, man. Good stuff. And what's great, and I think that this is awesome, and I want you guys, Paul, you've been with me, what, a couple weeks? A couple weeks, really. And you're still coming to terms with terminations, and or, you know, like the terms, 3 weeks. But what you've noticed from taking pictures through annotation is that this look right here stands out to you a lot, doesn't it? That look, you're like, whoa, I keep seeing this thing. I keep seeing this look, and this is what's amazing. So, Paul, what you need to do is I want you to start flooding your spreadsheet. I want you to go back and keep studying it, because this may be your trading plan. This may be the one that you take. This might be the only one that you take. And you just make $400 or $500 a pop, and you do it on a 3 or 4 lot, right? Like some people we know. And what it does for you is it says, hey, now I have a plan that speaks to me. Now I have a plan that I don't have any problems recognizing. Now I have a plan that wins more than it loses. Maybe this is all that I focus on, and I learn to exercise my patience and just wait for that look to come to be. So I love it, man, and I love that you're finding these trades and that you're creating these looks that really give you warm fuzzies. And then Nathan, I thought it looked strong enough to get in again, but didn't consider that a mid-band can be a termination condition. Mid-band sent small chart down. Did it, Nathan? Did it? Let's take a look. Let's see what we have. Yeah, you're posting. That's it right there. So Nathan, are you with me? Did you jump ship? Arg! Is Nathan's mama in here? No, that's okay. Guys, help me out. Do I have odds favorable and a clear path on the large chart? There he is. Nathan. Large chart. Awesome. 100%, right? Beautiful. Great read. And it even comes from a termination that reverses it. Holy smokes. This is the best of the best of the best. This is the one that's just absolutely beautiful. Your entry is the best. So here's where the lessons are going to come in, Nathan. This is where that rule number 3, there's your first entry, right? That's an area inside of favorable large triggers. Do you see how you also have an area inside of favorable large triggers down here? That's a pretty big window of opportunity, guys. So Nathan, I want to just absolutely shower you in praise. When I have a termination that reverses a market, when I have odds favorable momentum, and when I have a clear path, I love getting in at the highest point because everything on God's green earth says that the small crowd probably can't push that far. Does that make sense, everybody? When this chart is perfect, I'm in at the upper end every time, right? When it's this big. I love it. I've got every advantage known to man, especially with no divergence and strong triggers. And then let's watch how this trade begins to grow a little bit. So he takes the first entry, he gets quick profits, right? And then when this pulls back, do you notice the split in the triggers has gotten bigger? Do you notice that the small triggers are starting to work their way inside of the large triggers? We're losing momentum, guys. It's just one loss. And sure enough, it goes to the second correction point. Are you with me so far, Nathan? Perfect entry, quick profits, but now we're giving away momentum a little bit, right? And that loss of momentum, I want you to compare the two looks. Odds favorable, no divergence. Divergence with the small triggers working inside. I love your exit. Brilliant. Beautiful. Because this says that it may push lower. And it did. It absolutely did. But you're not in the trade anymore. So this is where with the split triggers, only one divergence, perfect conditions, I love a reversal bar off those synthetics to get me in. That's your second chance entry. Because the momentum is decreasing, wrong one. Let's type it all out so we can study this tomorrow. Because the momentum is decreasing, I'm not expecting the high end to hold, but rather a correction to the lower triggers. And then the reversal bar gives an opportunity. And then from this reversal bar, you get to the divergence high. That's your trouble spot, right? That's your yuck spot. That's your Holy shit, now the smalls are below the large. This isn't my best look. Now my smalls have turned on the large chart. This isn't my best look. So if you're in here or even here, there's money to be made. You jumped in. Your second entry is the dag nabbit all to hell. This market's going to go without me, and that's my money. And it didn't work out. And that's okay. I recognize it because I've done it 1,000 times, Nathan. So that small chart reading, right? And you saw it and you see it, and I love that you see it. You're such a great student. All of you guys are for annotating charts, for posting in. The best of the best gets you paid, right? And when you start forfeiting advantages, it becomes more difficult to get paid. You want to see something crazy though, Nathan? The smalls are still above the large, and all it did is it went to the bottom of the window, and that's where it started back up from. How crazy is that? This weakness said we're going lower, and it did. That reversal bar, because nothing changed over here, said maybe that's a second shot. Try to understand, why would you want to buy in when the smalls are below? Paul, you wouldn't. And that's exactly what Nathan said here. And in the moment, in the heat of battle, we don't always recognize that. But I guarantee, Nathan, you're probably going to remember this lesson because you had the courage to post. You're probably going to remember this lesson because it resulted in a loser. You're probably going to remember this lesson because you understand that it's the chart reading that creates the advantages. And man, props. And Nathan, you look young in your picture, and I know that your mom's not that old. And what you're doing right now is you're putting yourself in a position that all of us 50, 60, 70-year-olds in this room waited 50 years to do. And man, your future, I'm so excited for you. I'm so excited for you. And I'm trying to get my kids in this too. My kids are wrapped up in being kids right now. And they won't come in and do it. Man, what great lessons. All you have to do is post. We'll talk about everything. Great job. All right, Mr. Flowers. So tell me what you're saying here. Pivot point off of divergence, favorable large triggers, roll over, wide separation. Can we talk about the pattern that we're seeing here? And let's just do large chart, if you're cool with that. Because the large chart reads the way, right? Large chart leads the way. So let's just look at the large chart first. The large chart, whoops, get over there. All right, so the large chart, I'm going to cover up your annotations. I hope you don't mind. The only thing we know for sure about the large chart is that I have weak triggers. The only thing that I know about the large chart is that I do have a clear path at the very top, at the pivot. There's no divergence, there's no loss of momentum, anything, right? So all the large chart says is I'm not going long anymore because of the weakness. Does that make sense? And this is where chart reading begins to pay dividends. This is JW in here. If I have weak triggers, not in an area, and the market starts the other way. The expectation, Paul, this is nothing more than a chart read. So I'm going to drop this picture in the room so that you guys can put it into your spreadsheet. Study this, look. The expectation is that it may retrace to the midband. What does that do for you? It sets the price for my first problem / target. Does that make sense? So right now there's no rules-based trade. This is just a chart read. This is just an expectation because of the weakness, because of it turning. So let me give you guys that picture. And then let's go to your second chart. While that weakness is happening up here where you circled, you're noticing a divergence. You're noticing a second divergence. But do you see how everything is still green and up? When your large triggers roll and give you odds favorable momentum, this gives you that momentum trade that you're looking for, Paul. This gives you that little bit, right? Weak triggers can go any direction. It doesn't need a reason. It can just happen. But your small chart identified the loss of momentum. It did it with weak triggers. It did it with multiple divergences. It did it with large going red, small going red. And what it does is it gives you an indication through small chart read that this expectation may have something to it. Does that make sense? So until I reach that mid band, until I reach that support, doesn't it make sense, that when I progress a little bit, when I get a little more comfortable, a little more familiar, that I might find opportunities on the way down. And it may be that momentum, jump in, jump out. It may be that pull through, snap back. It may be that mid band inside of the triggers. And I see 3 separate opportunities to make money, and all of them stem from an expectation of weak triggers in the middle of nowhere. And then once I hit this spot, I can say to myself, get the hell out. I made my money. Let's wait for it to be good again. So, Paul, I don't know if you had that much going on in your head when you took this picture, but this is a great way how chart reads create expectations. This is a great way how patterns that repeat themselves give you an opportunity to begin to look for more. So check it out. Weak triggers from the middle of nowhere. It didn't make it. But now I have weak triggers at a pivot stop out. Maybe that's the one that makes it. But if you go through, you'll begin to see it. Weakened triggers, middle of nowhere, straight back to the mid band. Weak triggers, right? Pivot, didn't make the area. Back to the mid band. Dun, dun, dun. Weak triggers, but when it gets to the mid band, maybe you took a shot up to it. They told you that it was still going to go up. So you can go back and begin to see these looks. You can go back and find these images over and over, and they're going to create opportunities for you. And then right now what we have is we had weak triggers with divergence, right? And it never gave you that entry. And now we have 3 divergences in the same price range. We have a termination. The smalls are beginning to roll. Some of you are saying to yourself, man, maybe if I get a little pullback to the small triggers, I'll look for an opportunity at least to get up to treble. And that's just expectations based on the chart read. It doesn't mean that there's a trade yet, but it means that maybe things are changing. Maybe we begin to get a bigger push. Smalls on the wrong side, termination, triggers didn't break, 3 divergences, large triggers are rolling. I love it. Price read or chart reads. That's what it's all about, guys. Oh, and there's that 2004 trade. Paul was sharing it. Paul W. And then Grant, termination, reversal, odds favorable. There's your little snapback. You didn't take it. There's your second little snapback, and you took that one up. And it's all based on the momentum here, right? It's all based on momentum here, and it's out before trouble. Guys, momentum for the win. Momentum for the win. I don't know how many times I can say that in a day. Momentum for the win. Momentum, path, money. That should be on a t-shirt. Momentum, path, money. There it is again, guys. That's not a high probability trend trade. Ron used to, yeah, that was live. Ron used to put these in the room and it would just panic me. But there it is live, right? Aren't the patterns the same? Isn't that's a termination? Weak triggers, no triggers through, 3 divergences. The small triggers never rolled. Small triggers never rolled, did they? That's the one thing that we're looking for if we're going to take a shot, is a little rolling of the triggers. And since it never happened, I'm not jumping in arbitrarily right here at these. Does that make sense, everybody? Not the 2004 trade because the small triggers didn't roll. Can I get a yes, an amen, a hallelujah? Both of my triggers are down. Just because it's a termination condition in the moment doesn't mean the market's done. Let's wait for it to be perfect, guys. Let's wait for it to be the right trade. Let's wait for some rules to be met. Let's wait for a statistical advantage. Something that happens more often than it doesn't. All right, Miss Cindy. Termination, into the area, gap theory. Ooh. Cindy, are you with me? I'm not going to kill you. You are my favorite Cindy in this room. You are my favorite Cindy Monrab. I don't know what it says after that. Monrabble 91. Is 91 when you were born? You're just a baby. So let's go through what we see. How is that getting out of high school? Termination condition. Perfect. And again, termination condition here. Cindy, do you remember the gap theory? And guys, this is for everybody. When price accelerates from the large triggers and I have room to make a full bar back to them. That's the gap theory. Why do we recognize the gap theory? Because the gap theory says that price is likely to close the gap back to those triggers. And this is just another pattern, guys. So the pattern is when price accelerates from those synthetic triggers, when it accelerates away from those large triggers too fast and too far, and it hits an area, price usually snaps back to those triggers. The gap theory, what it does for you, and here's the picture of it. Wow, that looks almost exact, doesn't it? It says don't take a short until the gap is closed. That's all it says. No shorts until the gap is closed. Because if you take a short right here, it may close the gap and get you. Does that make sense, Cindy? What you took is because of the termination, because of the momentum, because the smalls broke through, because of no divergence, because of strong triggers, you said, I'll take a shot low, right? I'll take a shot right here because let's be honest, from a great top with momentum and everything, this thing may go down for days. So here's the challenge on a trade like this. I don't disagree. The gap theory got you. That was one of the biggest problems. But you're expecting it to go from here, right? Because of momentum, because of no divergence, because of the termination, because of this. You're expecting this area to break. Does that make sense? We're just going to go through it chart read. So if I'm expecting this area to break, if I'm expecting continuation down, if I believe that this fib, this mid-band are the reason that this market's going to continue in that direction from this little snapback, Cindy, is there any reason to say, or not to say, I'll risk 50 bucks on it? I'll risk 50 bucks on this trade and I'll only go off of the large triggers because I know that if it blows through this mid-band, if it blows through this area, well then chances are it's at least going to close the gap back up to these triggers. And I don't want to put that much risk on it. I don't want to lose that much money on a maybe trade. So this is one of those ways that as you grow a little bit, you might say, it's not perfect. I'll take one small shot right here. If it doesn't just go, if it doesn't just go boom to the downside, it's not my trade. And then look at this. There's Paul's trade. There's the small triggers through, little snapback, and it comes down. And then there's that loss of momentum. and then it gets a little dicey. Cindy, I love your read coming off the termination. I think momentum is great, and it's just that gap theory got you. That recognition in the moment. Oh, there's no tears, there's no crying in day trading. But what happens, and you guys will realize this the more you grow, is that with the chart sitting still, Cindy, it's pretty easy to see it now, isn't it? Like without the adrenaline, without the excitement about getting in a short, without hoping that that market goes down. It really is. It's easy to come back. Guys, this is why I look so smart. It is totally Wizard of Oz stuff. I'm the man behind the curtain. I don't have any connection to this trade. I don't have any emotional attachment to this trade. I don't have anything with this trade. It doesn't affect my world one way or the other. So what I can do is I can take a deep breath and I can come back and I can study it objectively. And I can say, well, I love the termination condition, right? And I'm just slowly looking, watching what it does, and I see that it hits the mid band and fibs. And then with absolutely no fear of losing a trade, the first thing I notice is that gap theory. After the fact, the trade is done. So it's easy for me to look at your chart, Cindy, and say gap theory got you. It's easy. And the cool thing is, Cindy, is it's going to be easy for you if you go back and take 20 pictures of the gap theory happening. If you go back, and let me open up my spreadsheet here, and let's see where I have them. There's a gap theory, right? And then there's a gap theory. Oh my gosh. And there's a gap theory. And then there's a gap theory. And they all look exactly the same. So what I'm doing, look, there's another one in my spreadsheet that says gap theory. So what happens is I'm creating recognition through repetition. And I begin to see this pattern so much that when the market is actually moving, I'm better at recognizing it because now it's on my radar. And Paul, it's probably not on your radar at all yet. But all of those are in my spreadsheet under patterns that repeat themselves. So what I'm going to do, Cindy, is I'm going to take your picture. I'll even get rid of everything but the gap theory. And I'm going to save it to screencast. And I am going to go to patterns that repeat themselves. And I'm going to drop another one in there. I'm going to drop another one in there that says gap theory. So thank you. You just made me a better trader. And if you go back, so the gap theory, Paul, we've got nothing but time. Oh, look at that. The trigger's never rolled. The gap theory, when we go back, it simply states that if price accelerates away from these large triggers and hits an area, Paul, it's likely to close the gap. That's it. That's all it says. There's nothing more to it. So if price accelerates away from the large triggers and hits a line, it's likely, not promised, to close the gap back to the large triggers. That's all it is. The gap theory is why midbands behave as termination conditions. If price reaches a midband, hold on, let me go to the rules real quick. So the first way you'll use it is if price reaches a midband and the large triggers are a full bar away, the midband is a termination condition. Price reached the midband, large triggers were a full bar away. These rules are built off of patterns, right? So here's another one. Let's put another gap theory into the spreadsheet. And guys, you can go through and you can put 1,000 of these into the spreadsheet, and I promise you'll get good at it. So the question that I always get is, well, how do I trade it, Mark? How do I trade the gap theory? And the answer is you don't. Not in the beginning. All this does is it says don't go long. Don't go long. That's it. Don't go long. Absolutely, I will. There you go. Yeah. And then, Paul, do you have my spreadsheet? Guys, there's my spreadsheet. Yeah, I update it almost every day. So every time I throw it in the room, feel free to download the new version, copy it over. Or if you ever want a picture that I take, please, 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 all you got to do is ask. I'll give it to you. But it told me don't go long, and look what happened. The market continued down. So what I can do is I can keep scrolling back. There's a mid-band support, terminations everywhere, almost a full bar away, and it does close the gap, and then it continues down. Full bar away, and it closed the gap. Full bar away, it closes the gap. So what it does is it keeps me on my toes, and it just says, you know what? With those large triggers a full bar away, even with odds favorable momentum, I choose not to take the long. And then eventually you're going to say, holy crap, with the large triggers a full bar away and resistance everywhere, maybe I'll find an opportunity to take the short. Probably not as a new user. Not yet. Great picture. Cindy, I love it. Great job. Sorry I had to beat you up so much. Ron, have a good one, man. Sunshine is sunshine. We're 73 and partly cloudy here, but I think I'm going to go play golf anyway because we got a bunch of rain coming up. Best wife ever. My wife goes, hey, it's going to rain the next 10 days. Why don't you go play golf today? Ah, it's raining there. Well, you're in Miami. Is it like it is? So in Sarasota, when I go visit my brother in the summertime, like every day for an hour it rains sideways. And then the temperature drops and it's like the best evenings ever, like every day in the summer. It's pretty cool. All right. Who was this? Andy. Andy, this was you? Oh, my Andy growing up. So Andy says, all the momentum in the world, weak triggers started it off. The mid-band is the expectation. Let it clear my problems with odds favorable momentum, and let me exit at problems. It's pretty easy like that, isn't it, Andy? And it was weak triggers at a bad bottom that creates the expectation. And it's odds favorable momentum. And then, Paul, there's your trade. Snap back to support and go. That's that one that you keep seeing. You going to the golf course, Ron? Good. I'm going to try and match you today. I'm getting closer. I've shot a 90 and a 91 the last 2 times I've played. I am just on the brink of the 80s. Can't wait. Andy, I love this trade. Doesn't it feel effortless when the charts are screaming in the direction you want to go? Doesn't it seem like all that momentum? That's just a momentum trade, Paul. That's all it was. It was relying, whoops, I closed it out. It was relying 100% on the giddy up of the market. That's all it was. And what he did is he said, I've got like some yuck over here. Let me get above it and not quite to the next yuck, and then I'll ride that momentum up. I know you do. I think more and more people are digging this trade. More and more people are taking this trade. Look at that termination condition. How cool is that? And it created a reversal. And there's your pullback to the small triggers, and look how it pulls right back to an area right here. And it's into terminations, but with that level of momentum, some of you guys are going to take this one and ride it all the way up to Fibonacci resistance in the next termination condition. And on the NASDAQ, it happens even more because the moves are bigger. So let's see. Just for grins, with all this momentum, NASDAQ for you momentum traders is pretty cool. There's a snapback, right? And there's one of those snapbacks. You could have traded into or you could have traded from. Trading from paid dividends. And then you hit fibs and look at the shenanigans, right? And then you get the momentum, and when it fails, it becomes a trend trade. And all these divergences, you're probably not staying in it. Look at the reaction at every fib that gets hit. Every time I hit an area, I get 3 divergences and a big pushback. Do you think it's a coincidence that the small chart shows so many fluctuations right at large chart key areas? And if you don't think that's freaking outstanding, guys, you got to tell me how to impress you, because that's all the fluctuations happening right here directly into the termination condition. Your small chart started showing fluctuations before they even reached. Guys, the fight started before the fib got hit. And then the buyers finally hit it. And then Paul W., not going short yet, right? Not going short yet. Let's let some triggers roll. Let's let some triggers roll and give ourselves the best chance of success if this is really going to be a top. There's that patience piece. Thanks, George. I try to give a few of those. And then, Paul, you're out at the one-to-ones. So you took that short. Let the large chart lead the way, right? I like your exit if that's what you did. Let's see if they come back and catch those triggers. Let's see. If this is really going to be a top, guys, triggers are going to roll. That's John Novak wisdom. If it's really going to be a top, the triggers are going to roll. This is from 2004, 2005. That is the momentum. Look at that. Breakthrough, snap back. That's from 2005. It's a momentum trade. John is sending me all the pictures right now. This was trade number 1 back in 2004, 2005. It's just a trend trade. Man, charts sure are easier to read now, aren't they? And then, guys, this is from the 2004, 2005 plan. Termination, triggers roll, sell a pullback to the triggers line. How cool is that? That Nexgen has been doing this for 20 years, and the patterns still repeat themselves. And oh my gosh, the triggers rolled. There was your pullback, right? If it's really going down, it's going down. Once those triggers roll, giddy up to the downside. Isn't that awesome? How many opportunities did you have to get stopped out before it finally rolled and went down? Paul said, once the smalls roll off that final divergence, I'll take a quick one. And then when it bounces up, no divergence, odds favorable, little reversal bar and just rock it to the south side. Look at this one. Barely a 50-50, 2 divergences, and it doesn't seem to be breaking. It made it to trouble, 50-50, divergence off the 50-50, split triggers. I don't know what's going to happen, but I don't have rules met. What do you think, guys? How'd we do on this first day of May? Are you learning stuff? Are you learning to let the large chart lead the way? I hope so. Are you learning that momentum seems to create a lot of opportunities? Are you learning that termination conditions can really F up your day, even with odds favorable momentum? But you guys are so stinking brilliant that you knew about it an hour and 20 minutes in advance? I'm telling you guys. You know, my brother used to say this, and I say it, and I always feel cocky when I say it. This is the greatest software that you're ever going to find, guys. This is the most expensive hammer that you'll ever buy at Sears. This is the fastest car that you can ever purchase from the dealership. This is the, I don't know. Yeah, you remember that place, right, Paul? I'm showing my age. Home Depot. Yeah, they bought out Sears. All the Craftsman's there now. But guys, this is it. Just owning it doesn't make you awesome, right? Just owning the software doesn't make you a great trader. Having the means to purchase the software doesn't make you a great trader. Learning how to use that tool, that's what gets you where you want to be, guys. And that's why we focus so much on advantages. And that's why we focus so heavily on these very, very basic concepts. Because what happens, and Paul Flowers, you are the epitome of this. Paul W., you are as well lately. Grant, all you guys, is you're taking these very simple concepts and you're finding your trades from them. You're finding what appeals to you. You're finding what makes sense to you. And every time you win, it feels good. And every time you lose, you have two choices. It can feel bad, or you can post it in the room and we can turn it into a lesson, right? Cindy, how valuable is this loser going to be for you? I think it has value for you and for everybody else in the room. It did. They lost momentum. Sears hit a termination condition. But by posting this, okay. So guys, every day we talk about the advantages, and every day we work our way just a little bit better. And the reason that I went to this is how we're going to end class. Is down towards the bottom, there's a psychology of trading thing. And it says learning to trade at a high level goes beyond simply making money. Guys, making money is a byproduct of your ability to read the charts. It involves understanding which Nexgen indicator patterns can be executed confidently, which comes through trading both winning and losing trades. And you have to embrace the learning process. You have to not fear losers. And as long as you share your trade outcomes in class, share your trade outcomes, not just your entries, right? You're going to promote growth. You're going to prevent repeating mistakes eventually, and you're going to keep your focus on consistency and achieving successful results. Doing it on sim is huge. Understanding that there is a psychological effect that comes from entering the market, from risking money. It's the same reason people start losing in Vegas and they start doubling up their bets, and they start borrowing money, and they start believing that even though nothing has changed, that their luck will change. And guys, that's not it. You create your own luck in the markets. And with a deep understanding, your analysis advantages and consistency executing, it's going to positively influence the psychology. And if you find yourself trading with fear, anger, frustration, seeking revenge, stop for a minute, walk away, take a break. If you see yourself breaking your rules, guys, jump ship for a minute, run a lap. And if you see your rules broken and it goes anyway, learn the phrase, not my money. That's not my money. That one doesn't have a statistical advantage. And then guys, my promise to you, especially as we're even building steam, is, and it's true, Paul, is as long as you promise to keep posting, I promise to give you feedback. I'm here for 15 hours every week. And I always say, and this shows my age too, Tiger Woods had a swing coach, and Michael Jordan had a shooting coach, and Wayne Gretzky had a hockey coach, and Serena Williams had a tennis coach, and Cindy had a volleyball coach, right? And everybody that's ever been great at something, top level, typically had a mentor, had somebody helping them through the process, had a set of eyes on the sideline saying, hey, you probably didn't notice this in the heat of the game, but let me show you how your hands looked when you shot this shot. Let me show you how your wrist bent. Let me show you how this happens. And they're the same people at the final table because they have a plan. And they don't break their plan. And that's the thing. Have you guys ever noticed that the people that never seem to post losers in here post the exact same trade over and over? And if you go over to the main room, the people that seem the most consistent are the people that post the exact same things. And I'm going to let you in on a secret. And maybe I'm not supposed to share this secret, but I'm going to anyway. I would say 70% of the people that post all the winners are let me kill the YouTube one so nobody can come back to me on this.